What if I told you you could get a copy of the Edgefinder completely free thanks to this live stream's sponsor, 8cap? 8cap is a regulated brokerage that has a special offer for viewers of our channel here, and I wanted to tell you a little bit about how this offer works. There's really only 3 simple steps to setting up a free copy of Edgefinder through our partnered broker, 8cap. Step 1 is you have to use the link being dropped in the live stream chat or down below in the description to create a new account. Step 2 is go to this link, scroll down on it, and you'll see the requirements that you must make in order for 8cap to essentially buy a copy of the Edgefinder on your behalf. Once you've created an account and deposited the required amount of money in order to qualify for one of the offers on that page, step 3 is to simply contact 8cap and or A1 Trading's team. On that page, there will be information for that. And then we will be able to essentially grant you access to our tools completely free, bought and paid for by your new brokerage, 8cap. Unfortunately, 8cap does not accept US traders. However, if you're outside of the US and interested in exploring this offer in more detail, again, like I said, we'll have that link in the live stream chat or in the description down below. Alternatively, you can just head over to a1trading.com/8cap. Thanks to 8cap for sponsoring today's show. Now back to the content.
Hello. Happy Wednesday, ladies and gentlemen. How are you all doing? Hope you're all having a great start to your weeks. Although I suppose we're halfway through already. I know the question is going to come. I'm not Nick. Nick will be on later to take care of the Fed decision and all of the fun stuff you've got coming later today. So I'm here to open the show, and yeah, you'll have your favorite host on soon. So as for markets, to be honest, I'm a little bit out of touch. I've been taking care of some other things over the past week or so, but I'm still in pretty much all the positions I showed you last week. So I'm still in the Aussie New Zealand longs, running perfectly well. We managed to finally break out of this resistance level, so that's completely fine. And we are quite nicely on our way to take profit from here. So it's really just a case of trailing stops now. I've got max allocation in terms of my my initial entry and 2 scalings. I'm not willing to put more on the line because this market is quite extended on higher timeframes. And I think the Australian dollar is very overbought, not just technically, but also fundamentally. It's priced in a lot of the positive Aussie data that we've had. And obviously the hawkish RBA and things. So I think it's a little bit more sensitive. And what I mean by that is, you know, when things get extended and overbought, if you will, it takes less and less for it to start reversing and start cracking. So I'm not willing to put more money on the line or to get overly aggressive. So I'm happy with the positions we've got. And we'll leave it there. Although Aussie New Zealand is still on the Edgefinder, as far as I was aware, unless it's disappeared. I think it may actually have disappeared upon checking it right now, but that's fine. Like you can see here, we've already got the initial position. We've locked in 1.25% profit. We've got a little bit locked in on the second position, and this third one is break even. So regardless of what happens here, we're in the green. The New Zealand US dollar, we're still in this one. So last week I was considering cutting it. We didn't do that. So pretty much we were looking to cut this position around here. I think I was on the stream at this point. I was saying we weren't getting any follow through at the time, or previously when I placed this position. The New Zealand US dollar was getting a bearish read on the Edgefinder. The daily time frame, we had to pull back to the fib. It looked fine. However, the trade quality just kept decaying and decaying. And then we had this move. So I decided to hold it over the weekend. We had a little push to the upside, created this ugly level of resistance. And now obviously we're in the green. However, we are seeing the New Zealand US dollar reading has completely crumbled. If we're going to find it here. So there you go. You can see we've gone from being in a bearish bias to now 0. I'm not sure, excuse me. I'm not sure. Obviously, this isn't necessarily relevant because I think it's more of a bug. I think technical, institutional, sentiment, economic, and growth all bearish. So it's still okay. However, my initial thought process is dropped off the Edgefinder. Not great, but we'll see how it goes. Anyway, Euro Pound, I'm currently sat in a sell limit. I'm not in this position yet, unfortunately. Been almost tagged in last week, almost tagged in again earlier this week, but still no potatoes on this one, unfortunately. So obviously we've got the fib from the high over here to the low-ish. Obviously, it's changed since the time I drew it, but still looking for a retracement back into this fib zone, back into this 200 moving average over here, and also to retest this previous structure. And that would just form a really nice pullback, break and retest pattern, and look for the continuation to the downside. Because we do have euro pound over here, very bearish. Score up -9. It's looking fantastic. I really like the fundamentals, like the price action. Again, it's just a case of waiting to get tagged in. If we don't get tagged in, fine. What can I do about that one? Swiss yen, still in a position in a little bit of drawdown on this one. So I've got an entry over here at 203.5, bounced off the H4 200 moving average really nicely, and now we're coming back up. I'm not really bothered about this one. It's a very small position. I'm happy to let that one run for a little bit and just collect some swaps. And finally, we're in the Aussie Swiss position. So again, we drew the fib from the low over here to the high, entered on this pullback into the fib. And yeah, really nice development on this one. I cannot complain at all. And of course, Aussie Swiss, very bullish on the Edgefinder. So how can you complain? Absolutely fantastic. Anyway, we'll move on. Do I trade in a CFD broker? Not necessarily. I trade, well, 50-50. I trade on Darwin, and I also trade in interactive brokers. So in interactive brokers, I'll yes, trade CFDs, trade some futures, trade some options, although my options knowledge is very, very limited. But yeah, I trade pretty much everything at this point. When I say everything, I mean in terms of ways into the market. I don't mean every market. Hey James, fun fact that you speak of the AUD we discuss. Oh, you're discussing it in the Discord. Very nice. I'll be honest, I don't check the free chat really ever unless someone tags me, so I probably missed it. You got stopped on Aussie New Zealand. That's unfortunate. Although I'm fairly sure you took the other side of one of my losing trades, so I think we're even actually, Max. What about Euro Aussie? I'm not really a huge fan of that market anymore. Where is it? Over here. Yeah, so in my opinion, so I wouldn't look to go long. I think, if we're looking at the H4, obviously we've got this bearish trend. I'm not sure if the Edgefinder's got a reading still. The Edgefinder does still have a bearish reading. So yeah, by default, I would want to go short, but I'm just not really feeling it. I just think it's a little bit extended over here. Monthly time frame rejected, or almost rejected off the 200 monthly 200 moving average. Weekly looks like we could be forming a bit of a support over here. So I just think, given that with the higher time frames, and also the idea that the Australian dollar has just been so dominant and so bought this pretty much all year, it's just getting fragile. It's getting crowded. I don't like to be in crowded markets. So while I think there's potential, I just think, yeah, I'd rather just either wait for something that's really convincing, wait for the reversal, whether that is the Australian dollar flips bearish on the Edgefinder, or the euro turns more bullish. I don't know. I need to see something to sort of drive a catalyst for me to be involved again, because right now, as I said, it's just too crowded, and I think the majority of the downside has already happened. Of course, I could be wrong. We could drop another 2% this week, but that's just my view right now. Oh, not the free one. Okay, right. Well, I've also not really been in Discord over the past couple of days. Yeah, just taking care of some personal and business things. Really boring stuff. Do you trade Forex on IBKR? I do, yes. You said you're long on Swiss yen. Yeah, very small size. So this one was actually a signal. So obviously, to be transparent, I think we entered, in fact, yeah, we entered roughly in this area. I think the actual entry may have been slightly different, but obviously I got filled here. For anyone that does trade in interactive brokers, you'll know market fills are, oh God, they're horrible. Makes me thankful for CFD brokers faking liquidity. Anyway, yeah, so this position was actually stopped out. However, because I took a small size, I like the swaps. I'm still, I've repeated it so many times, I'm still very bearish on the yen. It's still a funding currency. It's still, in my opinion, great to be a buyer of dips. So I'm holding the position. Again, small size, nothing crazy on the line here. But yeah, looking for it to come back up and basically just continue to run for a little bit. I am getting a little bit cautious of a MOF intervention with the yen, though. Dollar yen seems to want to break out of this range, where then, next stop really is coming into the previous all-time high. So yeah, I'm not going to sit in that one for too long, but I'll see if I can do something with it. Sluggy, hello, good to see you. Take on the dollar. We can have a look at the dollar in a second. Euro Aussie makes sense, but after today, I'm not sure. Yeah, I mean, also don't forget we've got the Fed tonight with some news that could be quite market moving. Maybe not. It could be completely uneventful. I think we've got 100% probability of a hold on CME Fed Watch tool, so I don't think it's going to be very eventful at all. But you never know. So could provide some reposition opportunities. James, does IB have huge difference in spread? Well, this is where I'll be honest with you. I got I don't know what the right word is. I got taken by surprise, I think is the nice way of saying it. So the spreads really aren't that much of an issue, in my opinion. What is an issue is market executions, because I wasn't aware, and this might have just been me not thinking or being a bit naive. I just didn't take into account the fact that CFD brokers, Pepperstone, 8Cap, all of the generic brokers, essentially fake liquidity. So when you market execute, you get the price you want, unless obviously spreads and that type of thing. But generally speaking, you get the fill that you want. Interactive brokers doesn't do that. They will fill you at the actual best price. So for example, if I market execute here on Aussie CAD, it might actually fill me up here or down here. It's really frustrating to deal with. So if you are trading on interactive brokers or any other broker that uses real market liquidity, limit orders really are the way to go, because again, I got a really nasty surprise with that one. I had a normal position. It was like 1% risk. I ended up having to take like 2.5% risk because I got such a bad entry, and I still needed to keep the stop loss where it was. It was not great. Anyway, expecting neutral FOMC. Yeah, I would kind of agree with you there, Sluggy. Bashi, good to see you. Hope you're well. Can speak about gold. Yes, so we'll do the dollar and then we'll move on to gold. So actually, let's just take a quick look at oil before we go to the dollar, just to provide some context. As I said, I've been a little bit out of touch with the charts recently. So oil is doing very, very well. It's not a huge surprise, technically speaking. We did, we've still got this sort of imbalance, if you will, whatever you want to call it. Naturally speaking, I would expect oil to come back to at least 112, maybe higher, maybe back up to around 116, 120. I don't really care. But having said that, the point of me bringing that up is we're obviously seeing yields up on the back of that as well, which is supportive for the dollar, negative for gold. So the dollar is, again, not really any surprise that we are seeing a bit of a bid on the dollar. However, overall, we're still stuck in this sideways range. So technically speaking here, I wouldn't mind seeing the dollar come up to, where would this be? Let's say 106, just to keep it with easy round numbers. That would be my target on the dollar. As long as it keeps its war premium, as long as yields stay elevated, I think the dollar could get to 106, especially if we have escalations in the Middle East. So moving on from that brings us on to gold. So if we've got yields up, we've got the dollar doing quite well. What do we expect to happen with gold? Well, obviously gold down. So clearly we're in a downtrend here, 200 above the 50. Prices obviously, breaking recent lows. Very straightforward. It's like technical analysis 101. So for looking at trades, I don't see anything. If I had to say something, I would be looking to go short, but I don't want to short gold. So you've got two options really. You either look to go short. This isn't financial advice, by the way. This is just my opinion. Either look to go short or you just wait. There is no reason to be a buyer of gold right now, in my opinion. I suppose the other side of that is if you wanted to do something like this. So what I'm doing is building up a long-term position. It's basically just accumulating silver, but this isn't a swing trade. This is more of an investment approach. So I'm just buying silver, very small size on dips whenever we get to key levels. So I'm looking to buy actually when we get down to £50 UK. then I'm looking to buy again at maybe 48, 45, and so on and so on. So you could, if you've got the bankroll, obviously gold is quite expensive to basically trade in terms of price movements, and obviously 0.01 can still be quite a big impact. So if you can't afford to do that, don't do it. That would be ridiculous. But that is another approach if you've got the money. Joshua, hello. On IBKR, you actually invest instead of buying a synthetic derivative like CFDs. Well, I do trade CFDs on Interactive Brokers. You've got to meet certain margin requirements, and you've also got to pass certain tests. That's the other thing with Interactive Brokers, actually, which can be a bit frustrating. You've got to take what they call, like, not an IQ test, but like an experience test to be able to trade those instruments like options and futures and so on and so on. But yeah, no, you can trade CFDs and Interactive Brokers, but again, it's not the same environment as trading with 8cap, for example, which is the sponsor of the channel, by the way. But yeah, it doesn't make a difference, really. I mean, it doesn't matter who you trade with, because generally speaking, if you can trade, you can trade. Anyway, what else are we gonna look at? Actually, let me just quickly. So Alan's coming on in about 15 minutes. Cool. We've still got some time. So we've already looked at Euro Pound. I would still quite like to go short, as I've already said. Euro Aussie, I can't really argue. We've got a bearish reading. The trend is bearish, fine. But again, as I've already said, I just think it's a little bit stretched and overbought in terms of the Australian dollar. Aussie Swiss are already in, so I'm happy to sit through that one. I wouldn't look to buy Aussie Swiss just yet. Actually, hold on, let me just backtrack a little bit on that one, because we are having a pullback. So what we could look to do here, let me just get rid of that. We've got, and when I say we, I'm talking more about me. I'm obviously not here to give you signals, but something I wouldn't mind doing is if we can get some sort of rejection off this level. Let me just change that to a support here. That would be quite nice. So obviously we take the new low, or the most recent low, to the high over here. So this, in my opinion, this would be the bullish leg. Some might argue it's down here, but it doesn't matter too much. Pull back into the fib zone, retest these previous highs over here. If we can see a rejection, we could trail the initial stop here to break even and then look to add a position in. Maybe that would be valid. I'm not willing to do that, but the idea is there for sure. Moving on, pound Swiss. To be honest, I don't like pound Swiss either. And it's not because of the reading, it's just because of the market. So the swaps are quite nice if you're buying pound Swiss. However, you're really fighting the market on this one. So monthly time frame, very bullish. Very bearish. Weekly time frame, also very bearish. Daily time frame, very bearish overall, and we're now seeing a rejection off this 200 daily moving average. A little bit of just multiple red flags for me on higher time frames. However, if you are more of an intraday trader, maybe there's an idea of looking at this gap getting filled. So you might want to look for just the next pullback, then look to go long into this market gap, take profits there, and then potentially look to short. But again, that's not my plan. I don't like this market. It's expensive to hold short positions on swaps. Long positions, you get paid quite nicely, but again, you're trading against all of the higher time frame trends. Of course they do. They're protecting ignorant investors. Yeah, that is true. I think Interactive Brokers actually have a very nice sort of customer care, if you will. But I'm sounding like I'm sponsored by them at this point. I've got no relationship with them. It's just talking from my experience. Gold, we've already covered gold. Just to quickly recap you, I've got nothing here. Really, I don't want to be involved with gold. If I had to be, I'd look to go short, but there's no reason to be a buyer. But again, I don't want to be a seller of gold, to be honest with you. Actually, we can also just check the scorecard for gold and just double check what's going on. So yeah, it's getting a score of -2. So overall, the landscape in terms of like yields and dollar strength, very negative for gold. Then we look at the Edgefinder, it's got a score of -2, so it's not swaying bullish. It's not really swaying bearish, to be honest with you either. So yeah, there's just nothing here. So let's have another quick look at the top setups. Aussie dollar is still getting this bullish reading, which is obviously good for my positions. Excuse me. But I mean, I'm not going to repeat myself. As I said, I just think it's getting a bit fragile. Dollar yen. Let's have another look at dollar yen, actually. Let's go out to monthly, then we'll scroll down. So, yeah, I think market participants are starting to get a little bit concerned about interventions. I've said it before. I don't think it's going to be right now. I don't even know if it's going to be at this previous all-time high. I would imagine it's going to be a case of we reach the all-time high, we see whether it be profit taking or just fear, a little bit of a downside, nothing crazy, then continue higher, and then we get the intervention around 163, 164, 165, potentially. Again, as I always say, I could be wrong. No one knows, but that's just my thinking. So I wouldn't mind being a buyer, but I think I'd have to take a lot of caution. So it would be a case of a relatively tight stop, low risk. In terms of targets, I'm not sure I'd be really looking to go beyond sort of 161.8, let's say. Jeremy, hello. EuroCAD. I don't really have anything on EuroCAD, actually. Let's see. Yeah, there's no Edgefinder reading. I don't have a personal bias either. However, if we just take into account what's actually going on, we've got oil prices that are obviously getting supported and actually doing very well at the moment. We've had the H4 moving averages cross here from being bullish to being bearish. Overall, actually does seem like a nice shorting environment. However, if you're trading the Canadian dollar, whether it be EuroCAD, Aussie CAD, doesn't really matter which one, you're getting involved and you're going to be betting quite heavily on the outcome in the Middle East and the Strait of Hormuz. So if we do get de-escalations or we get any sort of development, whether it's positive or negative, you're susceptible to that quite significantly. So that's something you do need to obviously be aware of. But right now, given that oil is doing well, given that the H4 trend is bearish or just flip bearish, I wouldn't mind looking for I wouldn't mind looking for shorts, but personally, I wouldn't really want to be involved. Duza, hello. And said the USD melting nicely. Yeah, it's doing okay. I just need to see it close below the support level here. But yeah, we'll see. I'm not overly bothered about this market, to be honest with you. I'm not really positioned heavily at all. So Swiss yen, again, is very small. Aussie Swiss is fine. I'm not really concerned about this one at all. It's having a relatively healthy pullback. It's quite deviated from the 200 moving average down here. It's expected. New Zealand, US dollar were already break even. And obviously, as I said earlier, the Aussie New Zealand positions are all either locked in profit or break even. Okay, right. So S&P 500. So as I've said previously, I'm not wanting to be involved in the stock market right now. And, it could put me in a position where in 6 months' time, I'm kicking myself because I've missed a massive move. But I am just really not convinced that this is sustainable. I think we're going to see either at least at minimum, and this is a big, I think, I don't know, but I do think we're going to see corrections of these moves over here because they're so impulsive. And if we think about what's been driving this, we've had a couple of things. We've had obviously risk on. I mean, that's undeniable. S&P 500 has rallied. We've also seen front running of IPOs. So things like SpaceX, Anthropic, OpenAI. That's an absolute disaster waiting to happen, in my opinion. Because AI is just a money pit, burning money on a daily basis, very little revenue, from what I understand anyway. So I just don't think this is the time to be involved in the S&P at the moment. When I say not involved, I mean short term. Obviously investments, that type of thing, that's not what I'm talking about. But yeah, I wouldn't want to be really getting positioned in the S&P. Same thing for the Dow, same thing for the Nasdaq. Pound Swiss, we've actually discussed. I've got no interest in that market right now. Pound New Zealand, I think we looked at this one last week. Let me just see. Is it still in the Edgefinder? It's not. So last week, Pound New Zealand was on the Edgefinder, and we were looking at this entry. So on the daily, we had a really nice trade setup, actually. So daily lows to daily highs, pull back into the 50% and the daily 200 moving average. We had a really nice close here on the daily candle. It looked great, but the fact that it's dropped off the Edgefinder, and right now the risk to reward idea just really isn't there. So I would need to really have a stop like down here. Take profit realistically would be at these highs. So you see what I'm saying? Negative R&R on this one. It's not for me. Pound dollar seems interesting, but again, given the dollar is doing well, it's getting that war premium. It just doesn't seem like the environment really to be involved in pound dollar longs, but technically, I think it looks great. Aussie yen, I quite like it, but there's not really any setup here for me at the moment. And that brings us round back to Euro Aussie. ECB inflation expectation massive beat the forecast. Yeah, I mean, I'm not overly interested, to be honest, right now. I don't mean that in a I'm not interested in what you say. Don't take it that way. I just mean, given the environment we're in, I just think the markets are very susceptible. It's not going to take too much to start seeing reversals or continuations and things like that. I'm quite happy to just stay as light as possible. Obviously, I'll take things if they align in terms of the Edgefinder, the technical setup, fine, no problem. But yeah, I'm not going to overthink things at the moment. Can you check dollar CAD? Yeah, we can. I think dollar CAD's a little bit of a difficult market to trade at the moment because, obviously, as I mentioned earlier, the Canadian dollar is obviously getting bolstered from higher oil prices, but the US dollar is also getting bolstered from the war premium and yields. So what can you really do? Which side are you going to take? Are you going to bet on the Canadian dollar with oil? Are you going to bet on the US dollar with sort of the war premium and that side of things? So as far as I'm concerned, you're kind of just trading two strong currencies against each other, which puts me in a position where I can't really decide where I'd want to be positioned. Would I want to be long dollar, short CAD, or vice versa? I don't know. So obviously that's my signal to not be in this market. I don't think we've got an Edgefinder reading. Let me just double check. Dollar Swiss does, but yeah, dollar CAD isn't on here. So yeah, Edgefinder's not there. Geopolitical landscape doesn't really support my personal bias either way, or give me a personal bias either way, I should say. And technically speaking here, we're kind of just stuck sideways. So yeah, flat there. Gold. Yeah, we spoke about gold twice now, so I'll repeat myself the final time. There's nothing here. So we've got yields up, dollar's strong. Edgefinder has got a neutral reading of -2. So there is no fundamental, the Edgefinder is not giving me a fundamental reason to go short. So I don't really want to be short. But with the yield pressure and dollar strength, I also don't want to be long. So, you know, there's nothing for me on gold, to be honest. And technically, there is no setup either. Pound New Zealand. All right, I've got a minute left, so we'll speed this up. So yeah, Pound New Zealand, again, we did already cover. I'm not interested because the R&R just isn't there. It's not a nicely asymmetric market or trade idea at the moment. And Pound New Zealand, is it still there or is it completely dropped off? I think, as far as I can see, Pound New Zealand has completely dropped off. And last week it was up it was either very bullish or bullish. Either way, it looked good last week, but it's just not there this week as far as I'm concerned. Aussie New Zealand trade is crazy. It is actually. I think it's probably so far the best trade I've had this year. So yeah, I'm quite happy about that one. Shorting gold right now, unfazed. I think that is probably the better option. But yeah, personally speaking, I'd stay away. But if I had to choose, yeah, short makes a little bit more sense in my opinion. Anyway, ladies and gentlemen, we have Allan Perez coming to take over the show. Don't go anywhere. You're in great hands with Allan. Fantastic guy, great trader, and very knowledgeable. So have a fantastic rest of your days, and I'll see you all tomorrow.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free to join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Hello, good morning, guys. My apologies. I got on the wrong link. I was a little bit confused here. Let me go ahead and share my screen for you guys. Okay, perfect. Can everyone hear me okay? See me okay? Hello, hello. Hey, Bashi. Hey. Okay, cool, cool, cool. All right, my apologies, guys. I hope you guys weren't in silence for too long here. As always, any chart markups, anything like that, feel free to drop those into the chat here, and I'll do my very best to go ahead and cover them. But happy Fed Day to all of you. I hope you guys are doing fantastic, and hopefully we get some volatility here. That way we can get some more trade setups. Gosh, put in ad blocker. I probably should, man. I think they're free too, right? Sluggy. Okay, cool. What am I watching today? I did get a pullback in Aussie CAD, which was something that I was looking for some time here. So currently got in field in this position here. Tight stop, low risk here, but we did get a pullback into what I think is some pretty solid support. I was talking in the chat here with Mr. Joey. Essentially, he was trying to ask a question on how to navigate like central banks, and especially when they are within close proximity as far as making rate decisions and stuff like that. I say, you know what, just pick the easiest way to do it is pick one that's looking to actively hike and look one that's looking to hold or ease. And so I think Aussie CAD is a great example of that. So Aussie, of course, we have elevated inflation. Labor market's quite strong there. They're looking to hike rates, and they do have the environment, the underlying fundamentals to support that. Whereas Canada is looking to say on hold right now, and they also have the environment to support that for now, at least. Now, if you were to continue to get some elevated inflation in Canada, and they have to obviously address that, then they have to hike rates, and so this trade gets invalidated here. But because we are near some highs here, we have had already a big move in Aussie CAD. This is a very small trade for me. 63 stop loss pips and 100 pips take profit there. Ideally, though, if this were to not hold up here and I get stopped out, I do like, if I measure this recent leg up here, I do like the 61.8% retracement level here at 0.96400. I think that's a very good solid level of support. Gives this thing room to breathe, pull back, and then we can continue to catch the bigger move. So ideally, that would be a good scenario as well. And if we were to get back into this level of support, I would obviously put some bigger size there just because we have retraced a good amount. But other than that, nothing else has changed here. I'm still in euro pound short. Pretty good. Again, another short-term trade. This thing is 40 pip stop loss and 40 pip take profit. It's a 1-to-1 trade, and we are in slight profit here. So we'll see. Again, hopefully we get some volatility today to go ahead and move this pair lower. Speaking of the Fed, speaking of central banks, we do have the Fed that is looking to, I would say, kind of neutral. We'll see how elevated inflation really kicks in and how the Fed is looking to go ahead and address that. It's a little bit interesting now because we do have oil up 6% today. And the recent or the near-term resistance here that we can pretty much gauge is 117. So oil inventories today came out very, very low. We also do have a potential another layer or an extension of the blockade there in the Strait of Hormuz, which is giving that oil premium today. So we will see. I don't like this. I don't like this at all. I think oil at 105 definitely can cause some inflationary pressures across the world. And we'll see how the Fed talks about that today. I'm curious to see if they will be asked about that. But definitely not good. Most economies will probably have to raise interest rates if they get elevated inflation for an extended period of time. So that's that with oil there. I like Aussie dollar as well, but just because we do have the Fed here talking today, it has USD in it. So I'm going to wait for after the Fed conference to go ahead and trade Aussie CAD. It is still trading here near the high. So ideally, I would like a pullback deeper into this level here. I'm also open to the idea with Aussie US dollar, that Aussie US dollar breaks above this level of resistance here if the Fed is dovish or neutral to dovish, and we get a break and retest type situation. I would also like that for Aussie US dollar. I see a couple comments here in the chat, so let me go ahead and do my best here to address you guys here. Good morning to everyone. DXY, por favor. Bashy, I got you. Look at UJ looking to have a big breakout. I will definitely cover UJ as well. So let's look at dollar, right? Dollar, in my opinion, has been kind of playing in no man's land. So we did have, initially break above to 101.5 or 100.5, sorry. And we are now in the middle of this zone here. So when we got here, the idea was probably like a breakout above 100.5 and then traded to like 102 or something like that. But then we just, reverse lower here. And this level here, 96.5, seems to be like a good, clean level of support. So since we are in the middle of the range, literally in the middle, dollar direction is right now is a little bit tricky. I've said this in the stream before this week, is that I would rather wait for some clarity as far as the Fed and how they're looking to tackle rates moving forward. So I think after today we'll get some more clarity and some more. I can make a more directional call on the U.S. dollar. But you know what? The fundamentals underneath the U.S. is not looking too bad. So I think it can go either way. We have Canada this morning, which they held rates. We had Bank of Japan held rates as well on Monday night. And then tomorrow we have ECB and BOE. So we have lots of central banks, and I think we'll have some clarity and some clean trade setups that we got. So dollar yen there, Max. Completely agree with you right there. I have marked up dollar yen here on this is the daily time frame here. We're just in a tight range here, and it seems like we are testing the upper limits of this range, and we are now in 160 territory. So maybe we do get a breakout in dollar yen. Again, if you get a hawkish Fed, this thing will definitely break out to, I would say, 161. And then after that, 162 would be the next target. So very, very interesting there. But again, this thing, anything can happen, right? If the Fed is neutral to dovish, then this thing falls over. And then this is just another time where you test resistance and you fold lower. All right, let's go ahead and see Kiwi dollar. I know a lot of Kiwi dollar there in the chat. So Kiwi dollar is performing the worst, I would say, as far as the major currencies here. Testing this level of could be support, honestly. We'll see how that plays out. Again, it's a little bit tricky to make the call. Kiwi dollar, I think, as a whole has been a very bearish outlook. So let's verify on the Edgefinder. For the most part, it's been very consistently bearish here. So let's go ahead and remove this one. Kiwi dollar to the short side, and yes, it is still a bearish reading of -8. So that is good as far as bearishness goes. If you were to measure this out here and go something like this from this to this, it seems like we tested that 61.8% retracement level, and we can actually be fading lower here. So that's definitely a possibility. Again, you're also at a level of what could be support as well. So we broke out above here, and we could be testing this, and this could act as support. So it can go either way, right? Again, we'll have to see how the Fed has their forward guidance lined up and see if they're looking to hike or ease or stay neutral. That would definitely go ahead and impact the Kiwi dollar. Let's go ahead and go over, right? Because I do like this pair to the downside because it's getting that bearish reading. So if you were to get a Fed that is hawkish, right? They're worried about inflation. Words like risk are tilted to the upside with inflation. Then I think Kiwi dollar short is a really good trade in my opinion. In fact, that'll be something that I'll be actively looking to take on here. Also considering that you do have oil elevated, right? You may get more of a risk on environment or risk off environment that'll put money into the dollar, right? Especially adding in a potential hawkish Fed tone. That'll definitely be a good trade to the downside, Kiwi dollar. So something that I'm definitely going to be looking after. Kiwi yen, not too much. I'm not really looking into that. I really want to trade something with the dollar as far as the major currencies. Most of my profits that I make throughout the year are with major currency pairs. Let's look at pound dollar. Pound dollar has done a little bit better when it comes to their growth. but it's been hanging out here at this level of resistance here. So we'll see. Again, a lot of the direction bias here when it comes to any major currency at the moment is going to be contingent on the Fed and how their rate outlook looks like, right? So pound dollar, again, I think upside is a little bit capped. They were in a position where they were looking to hike rates aggressively, like 2 to 3. And now they're looking to walk that back if necessary. So the pound dollar has priced in all of those rate hikes. And if you were to get a difference in expectations, you will have to reprice all of that into the pound. And so I think pound lower is possible as well. So, watch out for this level of resistance. So for any short sellers out there, anywhere above here in, 1.36 or 1.355, I think that's a premium, in my personal opinion. Dollar Swiss is actually a good one as well, man. So dollar Swiss, especially if you get, again, I keep saying this, but everything is going to be contingent on the Fed today. Dollar Swiss to the upside is possible if you get a hawkish Fed. If you get a neutral to dovish Fed, I wouldn't touch dollar Swiss at all. Too much going on there. So I like Kiwi dollar to the short side if you were to get a hawkish Fed. I like Aussie dollar to the upside if you were to get a dovish Fed or a neutral or dovish Fed. So those are my two things at the moment right now. Porch Perez in the house. I don't have a Porsche, but it could be nice. What about Euro Aussie? Euro Aussie, I'm not really paying too much attention to. Let's go ahead and look at that chart here very quickly. I think we discussed it before, and let me also go to the top setups page here. Let's go to Euro Aussie. Getting a bearish rating of -6. So it seems like I have this alert here on the chart here, and I think that's a retracement zone if I remember correctly. So let's go ahead and do this here. So yeah, we haven't even hit the 38.2% retracement level there for Euro Aussie. So I really wouldn't touch it. If anything, you wait for a pullback into the 38.2, the 50 to 61.8. It's getting a bearish reading on the Edgefinder, which is good. However, we're kind of like in the no man's land here. So I wouldn't touch Euro Aussie. And by the way, before I forget, guys, this tool here, this is like what I'm doing right now in real time and looking at your chart markups or looking at your tickers here, referencing the Edgefinder and then going back to the chart. That is exactly what I do every day. It takes me like 15 minutes at most throughout the day, and I filter out trades and I know what's good and what's bad, and I avoid the bad ones. So pretty much what I'm doing here, again, Kiwi dollar to the short side if you were to get a hawkish Fed, Aussie dollar to the upside if you were to get a dovish Fed, and then I have my euro pound position, and I have a pound, or not pound, I have which one did I take today? Aussie CAD. Yeah, Aussie CAD long. So very, very simple, right? You use the Edgefinder, you filter your trades, you match the technicals, right, to make sure that it aligns with what the Edgefinder is telling you, and that you're not trading. If you're going long, you're not buying at a premium, right? So it's very, very simple, and it's right now it's 45% off, which is the anniversary sale, and it ends in, I believe, tomorrow's the last day. I think tomorrow, because it's for the month of April, I think tomorrow is the last day. So correct me if I'm wrong there, chat. But this is the biggest sale of the year. They don't drop it any more than this. So it's not like they're going to do a bigger discount next week or anything like that. This is the discount. So definitely go ahead and cop yourself a copy of the Edgefinder. And if not, if you can't afford it for whatever reason, I would definitely recommend the Telegram as well. It's completely free value. And most things in life aren't free, but this is free for you. So go ahead and join that. All right, let's see. Euro US dollar, are you still on bearish bias? Yeah, Tayden, very possible. Very possible. It's contingent on the hawkish or the Fed commentary that we have today. Marco?
Oh, hello.
Hello, how are you? Yep.
I'm doing pretty well. How are you?
Pretty good.
Awesome. Some activity today. So big day. We have the Fed. We have Mag 7 earnings. I think we have 3 companies today, and Apple is gonna be tomorrow. Maybe I missed someone, but I think it's 4 major companies. So this week posting earnings. Market is definitely moving. My USD JPY is now above 160. So most likely current game plan is to maybe get in on a short after the Fed is done. So to see what's happening with the US dollar. But I definitely like this level to execute the sell position and then look for a sell-off, a big red candle to take some profit. I also have a buy limit on Bitcoin, which is probably going to get hit pretty soon. I think it's going to happen this week, I think. I mean, we're pretty close, so we'll see what happens with that. What are you watching? I know I think you took a new position.
Yes. So I have my current position
cool.
here, Euro Pound, running in very slight profit. This is a small one in terms of pip. So it's a 40 pip stop loss, 40 pip take profit. And I took this one here, Aussie CAD. We traded back into this level of support that has held up before. So I just took a small stab at it here. My stop loss is 63 pips, and my take profit is about 100 pips to the recent highs there. If this level were to not hold up, then I would go ahead and wait for a retracement level all the way into 0.965, and that is where the 61.8% retracement level is. So I like that idea a little bit more. So this is a small position. If I get taken out, I would probably take a bigger size position here at the 61.8.
Cool. So the Bank of Canada meeting was today. I scrolled through Financial Juice, but I didn't see anything substantial. It was just basically like, we are looking to cut, we're looking to hike, but we're not exactly sure what we will do. So the pricing, if we just look at what is priced in, it is still pretty hawkish. So if we go to the rate probabilities, we go to the Bank of Canada, the graph is still to the upside, and by end of 2026 we could get a rate hike, maybe even 2 rate hikes. Do you know maybe anything more about the BOC?
Yeah, so they are looking to go ahead and hold rates, ideally, and they are kind of like in that position right now where they're able to achieve that, but they're borderline. If you were to see more elevated inflation, then yeah, they probably tilt more into hiking territory. And in that case, this whole trade gets invalidated as far as the rate differentials go. But them being, that big oil exporter there, that's been helping them a little bit. Their biggest concern right now, too, aside the war and inflation, is the tariffs. That's like their bigger thing right now. The tariffs are hitting them hard, and so that's the battle that they're trying to fight.
Interesting. Yeah, I mean, so we got the BOJ, we got the BOC. We're gonna get the US later today, and then we still have the UK, which personally I'm interested in, and we have the ECB, which is probably gonna be a non-event. And then after this week, we could see some trends start back again. I mean, the dollar is already moving this week, so the DXY is. Let's just put the DXY there. Okay, the DXY is not that active, but I saw some pairs with the dollar moving. I mean, the biggest mover is actually the metals market. Gold, like silver, crapping out. Copper, not really moving much. Platinum, definitely moving lower. So that's so metals are moving. Stocks are kind of stagnant as well. They're probably waiting for the FOMC. That's at least what I'm thinking.
I like gold right now. Like it's kind of creeping to that level that I've been voicing.
Yep.
That 4,400 level. And again, like a lot of the movement for most current, like any asset, really, like a lot of people are would have questions on, like, this pair up or down, this pair up or down. All of them are almost linked in a way. And so, like, if you were to get a hawkish Fed, what that would mean for gold, probably lower. If you were to get a dovish Fed, higher gold. With the dollar, think hawkish Fed, higher dollar. And so that would mean if you get a higher dollar, then euro dollar, Aussie dollar, Kiwi dollar, pound dollar, all lower, vice versa. If it's the opposite, they're all interlinked there. So a lot of my biases right now are pretty contingent on that. But I'm very happy that we may get some clarity this week.
Yeah, we could get some clarity. I think it's Powell's last sort of conference that he will be holding. But again, is the situation in the Middle East cleared up? Not really. So there's a higher chance of it being a non-event rather than sort of being a market moving event. I think the markets are also pricing in pretty much a non-event as well, so that we don't get any more clarity. Unfortunate for us traders, because we need the volatility, we need the moves, we need the repricing to happen. So my focus is more on equities at the moment than on Bitcoin, if I'm being honest. So for Forex, I still think it's tough. I still think it's a bit quiet and a bit slow. So looking for buys on Bitcoin with the buy limit I have, and looking for that Nikkei buy as well, and looking for the earnings. I think we're gonna get the earnings in probably like 4 hours, 8 hours. Let me double check that.
Should be after the bell. You have, I believe it's Amazon, Meta, Microsoft, and Google. Marco, I don't know if you saw this. To kind of piggyback off of what you said, the war in Iran might be a little bit more in focus today. I don't know if you saw this here, but Trump and oil companies discuss steps to continue the Iran blockade for months if needed. So that definitely is what I would say is at the moment kind of moving this risk off move, where you have your risk currencies like the Aussie and the Kiwi down big today, and you have oil up 6%. So that's kind of one thing too that I'm trying to listen for, is like how much are the central banks really looking at this? Are they going to look past it? Are they not? Because we made some progress earlier last week. Now we're back in the 100s, which is problematic.
Yeah, I totally forgot to mention the move on oil. So oil is actually the biggest mover this week. And of course, gold seems to be inversely correlated with oil at the moment. So let me just bring it up here. Very interesting stuff around oil. So I did see that, and I think we also got something else. So we got the United Arab Emirates exiting OPEC, which could create some more instability in the area. Like the main thing about that was the Middle Eastern countries decided to get together and kind of create a cartel for oil and dictate what the price will be. And now there's going to be more competition because UAE will set their own price, like the US is doing, so that their neighbors may not like that as much. But of course, it could also lead to lower oil prices. I think I watched Nick's trade recap yesterday, and he mentioned it could lead to lower oil prices as the pricing becomes more competitive, as it's not dictated by the OPEC cartel. So we shall see what happens there. A lot of interesting developments around oil. Personally, I think Trump's strategy with the blockade is a great way to go, a great tactic, much better than trying to sort of put boots on the ground and keep bombing Iran, because like the casualties are extremely low, if there even are any casualties, while the pressure is building in the background. So like Iran is getting less and less revenue because they're not shipping out oil, and the US is hurting China in the process as well because China is not getting their oil. So China may put the pressure on Iran. So I think it's actually a pretty good strategy from Trump, which I didn't believe I was going to say, but I have to say it's pretty good. For us traders or for the general population, this is pretty bad because the strait is closed. The price of oil is going up. You mentioned it's again above 100. We can feel it at the gas station already. And it kind of messes up the whole risk on thesis, the whole risk on positioning that we were trying to build in the last 2 weeks, where the stock market started to move away from the Middle East. So it looks like it's back in the spotlight. We're going to have to keep monitoring that. Yeah,
definitely. And someone here in the chat just pointed this out here. I guess it just came out here, but Trump rejects Iran's offer and says that the blockade stays. And then here on My Financial Juice, US CENTCOM has prepared for a short waves of strikes on Iran, and Trump would consider military action if Iran does not act. So here we go again. Okay, we're back. Markets usually, it seems like we're back, right? What's that meme where it says we're back? Markets trade in themes, and usually, especially nowadays, the themes are very short-lived, but this one's actually, it's been going on for some time here. So again, seems like it's back in the spotlight. I'm curious to see what the reaction is going to be here for oil, but we do have, it seems like dollars catching a little bit of a bid here. recouping some of the losses that we had a couple weeks ago. So we'll see how that goes out. Look at Kiwi dollar though. Kiwi dollar is down almost 1%. I will assume my position here. Aussie CAD's not looking too hot, as well as the Aussie dollar, which is a risk currency, takes a hit.
Yeah, and one interesting thing that Brent Donnelly mentioned or has been mentioning in his newsletters is you used to be able to trade currencies according to their interest rate differentials. So essentially, the price followed interest rate differentials. There has been a decoupling, I would say, in the last few years, but mainly when Trump took over, like the decoupling definitely happened. So the currency price is no longer respecting the sort of interest rate differential. Main example, I believe, is the Aussie against the dollar, where the interest rate differential definitely moved, but the currency pair stayed flat for a long time and only moved up recently. UJ could be one example as well, where the sort of the interest rates keep on approaching each other and the edge for the carry trade gets smaller and smaller, but the price is stuck at 160 or 159. So the sort of the game has changed a bit. The things you can look at to build a position have changed a little bit. Currencies are no longer respecting those differentials, which some people say it could make it harder to trade, but for some it may be easier.
Yeah, I found that like the biggest moves in Forex when you're trying to trade like rate differentials is like the initial shift in narrative, right? So like if you have two central banks that are paused and one of them starts to shift hawkish, it's going to be in that first initial transition where you get the big move in Forex. After that, anything after that, it becomes very stale. Even if the rate differential widens or whatever ever so slightly, that it's not going to be as lucrative as the first initial move. That's why I watch the news closely, is because anything that can disrupt that narrative or cause something to shift, you want to be early in that move if possible.
Absolutely. It pays to be early, especially in trading. But that's why we're watching the central banks. If they can actually commit, and again, we don't even need all of them to commit. We just need one of them to say, look, we're going to hike, or look, we're going to cut. And then we can sort of get in on that initial push, initial trend. The biggest one could be the sort of the US, but also one thing that Nick mentioned in his recap from yesterday is that the sort of the BOJ creates the floor essentially, and when they hike, the floor is raised, and other central banks, they tend to even follow the BOJ. So it's not just that the Fed is the leader, it's also that the BOJ creates sort of the interest rate floor on the bottom where they make borrowing extremely cheap. And then they make it more expensive. They tighten the conditions. And then other central banks could follow that as well. So, yeah, hopefully we get some, or if we get some hikes from the BOJ, like we have priced in, I think current rate 0.75, we should be at 1.22 by the end of this year. That could create some trends for sure, as the yen gains value, as the carry trade deteriorates. I'm loving my UJ sell, which I'm most likely going to take. That could work pretty nicely. So we're going to have to wait and see.
Yeah, I do think that, especially in recent times here, when it comes to UJ specifically, if you were to get a big pop here, and this is something that I discussed, seems like I'm running out of storage on my computer on the drive. It seems like if you were to get a pop here in dollar yen to the upside, one of the scenarios that I discussed yesterday in the Telegram post, which is, yeah, it's very possible that this thing can hike lower, but it'll essentially force the Bank of Japan to go ahead and step in. Because one thing that they mentioned is, yes, they have a price in target as far as a ceiling, which is that 160 area. However, what would cause them to go ahead and intervene is the speed of depreciation in the yen. So if you were to get that quick spike, plus you add in that you're within that target range where they want to intervene, it's definitely a possibility. It's become more of a possibility recently.
What would motivate you to get in on a sell? Would it be a quick push to 1.6, 1.5, 1.62? Would it be a more aggressive level, maybe 1.63? Or yeah, what's your take on the situation?
Very tricky to do, I would say. What I would what I would see that kind of gives me some confidence there is if and this will probably not play out perfectly, but I can give you an idea. Um,
Okay, cool.
if you were to get a strong, oh, my Epic pen's not working. Let me do this. If you were to get a strong bullish candle, something like this, where you pop higher, and then you revert, you pop higher, right? This is like a 4-hour candle, you could say, or daily, whatever. And then you get another candle that takes out more than 50% of this big candle. I would say that's a good indication to sell. Now, if you were to get a big candle and then you were get something like small one, and then it's very likely here that you get another one that just consumes it and takes it higher. So essentially, just you get a big pop here, and then you get the next one that covers mostly this one right here. That would be for me a good indication.
Okay, cool.
A tricky task nonetheless, because it's not set in stone. It can continue going higher, yada yada yada. That is just like a way that I would feel comfortable, I guess you could say, shorting a high.
Yeah, two problems that I have with USD JPY and selling it. So let me just flip onto my chart here. First problem is the swaps, which could accumulate if we don't get any moves. So it could get pretty expensive to hold a short, especially if you hold it for like a month or even more. Second thing is, the higher it goes, the better is the chance of an intervention, and the more I want to be short. So like it's gonna approach the stop loss. Let's say I take a sell and I put the stop loss at 162.5. Like the closer the price gets to my stop loss, the more I want to be in this position, which creates some psychological problems. But you need to respect the levels at the end of the day.
Yeah, that's the tricky part. And so, like, to kind of like I guess counteract that psychological effect, which it happens to everyone, is to, I would say, trade small or trade smaller than you usually do, and then do have that wide stop loss, right? That would be the way to go on that. Once you get the confirmation that Bank of Japan did intervene, then you can go ahead and start adding to a winner if it starts to turn into a winner. But yeah, definitely, it's a tricky trade. I'm not gonna lie, it's a tricky trade. Do I want to do it? Of course, but you have to be careful at the end of the day.
Yeah. I mean, just going in with small risk is what I'm gonna do, and maybe get in on a feeler position, initial position, and then if it actually goes up even more, I can scale into it. I can slap on the full 1%, and see what happens.
You know what I do sometimes, Marco? I haven't done this in a while, but maybe this would be a time where I bring this strategy back. But
okay,
I take the small position right on dollar yen, and then I go to TradingView. You know, where it has like the free demo account. And I'll put it like at my account size, like what I have it at right now, and then I'll put a giant position on demo, and then I'll experience it through there. And most likely than not, when you size highly, you make wrong decisions. So the drawdown that I would see would be like, make me like, okay, you know what? I'm glad I didn't do this on the real account.
That's a great hack. I'm gonna look into that. Okay, that's pretty good. Yeah. For me, the only thing is, like, I don't want to risk too much. I want to get in, I want to participate, but just small risk. And that's an immediate warning sign as well, that maybe this is not the greatest time to get in. So yeah, gonna have to think about it some more. It's kind of on the radar. The next thing on the radar for me, like Bitcoin, I want to be in. Decision is there. Equities just waiting for a pullback. UJ, I've been watching it for so long now. It's at the level. It may be time to get in. So we're gonna have to wait and see.
Joshua says, and then just withdraw your demo profits. I wish, man. I wish. Sluggy says he does something similar as well. So just here. Awesome. Very good to know. Just a quick hack, guys. If you guys have an itch to size big, just do it on a demo account and then live it through there. But Marco, I'll go ahead and step aside here for you to do your portion of the segment.
Sure.
We'll have lots to talk about, and we can chat here privately as well if we see something come up. But yeah, we'll see you tomorrow.
Yep. See you tomorrow, and let's see what the Fed says. Yeah.
All right, man. Take it easy.
Goodbye. I don't have a giveaway today because we ran out of codes. So we're waiting for new codes to come. But I do want to mention, if you want to get funded, do check out DNA Funded, because we have a discount code for you. So the code is A1 Live. Gets you 25% off any DNA funded challenge. Okay? A1 Live, 25% off any DNA funded challenge. By the way, this is my personal 25K two-phase funded account. Current equity is around minus $839. So in the red, not doing so great. Down, I think, around 4%. I think it should be there. But part of the game, I'm just gonna keep on trucking, keep on executing, and see what happens. Had a great experience so far. There's a big broker behind this prop firm, and they're using TradeLocker, which in my opinion is the best software execution, or best software for execution. So, and one more cool thing, that when you reach the profit target on phase 1 or on phase 2, TradeLocker automatically closes your position. So you don't have to monitor all of the positions, be online, be on the charts 24/7. It does everything automatically. So I love that. A1 Live, 25% off. Do check it out. Watch list for today. I have the Nikkei, which is getting close to the buy level. My buy level is just around the 20 MA. I think we lost the bullish reading on the Edgefinder. Let me just take a look. So let's do the Nikkei. Yeah, Nikkei is neutral at the moment, but I would still be pretty happy to get in. I've been looking at this for a while now. Nikkei, my favorite index. I love it more than the Nasdaq, more than the S&P. It's been beating the S&P steadily. The government in Japan is dovish. The prime minister is dovish. There's capital flowing back into Japan. So getting in on a buy position does seem like a good sort of trade. BTC, I have a buy limit set. It's getting very close. It's probably going to get hit today. So the entry 75504. Stop loss 69957. Why such a big stop loss, you may ask? Well, because it's below a key level of 70K. Okay, just below 70K. I think that's a big round number. I think that could be a nice support level. It's deep into this range. So for me, it made sense. I saw some traders in the A1 Discord put their stop loss below 73.5. 73. That's good as well. It's totally fine. It's up to you. It's up what you want to do. But for me, if this thing actually goes up, it could be a pretty high reward to risk position, even with such a big stop loss, because I believe we can go back near 100K. We don't even need to go to crazy all-time highs, but only if we go to 100K, this turns out to be a pretty good winner. So those are the levels. This was a signal in the A1 Discord, and we're gonna see what happens. UJ, as I mentioned during the joint segment with Allan, UJ is very, very interesting to me. Most likely, here's my game plan at the moment. So I'm gonna wait for the Fed, because just to get more clarity, just to see what the Fed thinks. I think it's gonna help, right? It's going to help to see the Fed pass. Probably get the earnings as well, because earnings could be volatile. The Mag 7 earnings, they could be volatile for the currency markets, for sure. If you get a massive risk on, if you get Microsoft, Apple, Google, Meta, if they all beat their earnings expectations, we flow into massive risk on, and the yen loses value. Right? The yen could lose even more value. The dollar could catch a bid in that sort of a scenario. So I just want to see the volatile period of the next couple of hours pass, and then we can see to get in. Of course, if I do decide to take a position, you will be notified in the A1 Trading Discord. If you want to join the A1 Trading Discord, there's a link in the description of the stream, and you can use the code Marco to get 25% off. Okay. That's about it for the watch list. That's about it for my sort of favorite things for the day. Oil is going crazy. I'm not trading it. I think your edge behind trading oil is very, very small. You would have to forecast geopolitics. You would have to forecast what Trump is thinking, what Iran is thinking, which in my opinion is next to impossible. So this is not for me. Someone may have a better edge, better clarity. I don't want to touch it. I did take a couple of stabs at it. So I had one winner, I had one loser. Net, I'm in profit, but not a lot. I think 0.4, 0.5%, something like that, from when the war started. Gold, I definitely don't want to look for buy setups on gold. I mean, a very bearish price action below the 20 MA. I believe the Edgefinder, let me see, gold, neutral, score is -2. Yeah, I don't want to touch it. So comments. Bashi, hello, what's up? Haven't seen you in a while. Hope you're doing well. Let's see if we scroll a bit higher. Euro dollar, we can take a look. Okay, for me, EU is pretty flat. So euro dollar is pretty flat, pretty range bound. Looks similar to the DXY. It's in the middle of this range, and it's a big range, mind you. So the range started in June 25, and it's still going on. So Edgefinder is going to be neutral as well. And it makes sense. I mean, look, perfect score of 0. So neutral bias, score of 0, flat inside of the range on the daily chart. Personally, I cannot find even a smidge of an edge on this currency pair. That's just me. That's just my take on it. I think that yes, the Fed is dovish. The ECB, European Central Bank, they're hawkish. So the Fed is supposed to cut, right? I mean, right now they're pretty flat, but they were supposed to cut at least. While the ECB is supposed to hike, but the ECB is getting some really bad economic data. If we go to the Edgefinder, we go to the GDP, we go to Euro. So GDP growth, I mean, it's not really that big. Inflation is going to be elevated. I think it's going to be elevated. I mean, it must be. Let's take a look. Yeah, 2.6 and rising. That's because of the oil shock. And let's look at the unemployment rate. Is this rising? So is the unemployment rate rising? No, actually staying pretty consistent. Well, let's put it back to the euro. Last 2 years. Okay, the unemployment rate is fine. The main issue with the euro is if the ECB decides to hike. If you look at the last couple of times when the ECB hiked going into an oil shock, it didn't end well. It actually ended up costing the euro, and the euro ended up going lower. So the euro ended up selling off. Let me just check if or when is the next guest coming on. Let me see schedule. Okay, so Tiger will most likely come on in a minute or two. Anyway, that's sort of, those are kind of the main issues I'm looking at. So ECB hiking into an oil shock didn't end well the couple of last times it happened. I did a whole write-up on that in the A1 Discord. I don't exactly remember the dates, but I think we had 2 or 3 examples in the past where a similar occurrence happened and the euro dollar sold off. I think it was 2022. Let me take a look. So in 2022, we had so 2022, oil shock, Russia invades Ukraine, oil prices skyrocket. I think the ECB hiked during that period. We can go to ECB interest rate chart. Oh, no, not this. I'm on the trading economics one. Yeah, they definitely hiked. They definitely started a hiking cycle. And look what happened. Euro dollar sold off by a lot. So that's why euro dollar is very unclear to me at the moment. Anyway, that's about it. Tiger is coming on right now. So thank you very much for watching. You can catch me tomorrow. I'll be streaming tomorrow. On Friday, I'll be away, but then on Monday, I'll be back. So yeah, good luck in the markets. Let's see what the Fed says. Let's see the Max 7 earnings. If there's anything important, I will put an update in the A1 Discord. So keep an eye on Marco's journal. Yeah, thank you for watching. See you in the next one. Goodbye.
If you are a swing trader and you are looking to get funded, then check out today's video sponsor, Ola Prime. Ola Prime has a challenge built deliberately for swing traders. Check this out. The Prime Challenge offers the ideal setup for swing traders with leverage up to 30 times. They also allow news trading. Weekend holding is also allowed. They offer up to 95% in rewards, and they have a 100% challenge fee refund available if you are able to complete the challenge. I know that a lot of people who watch these live streams tend to be more swing trader focused. So when looking for a partner to sponsor today's show, Ola Prime stood out as a perfect candidate. If you'd like to check out Ola Prime for yourself and get a live stream discount, then check this out. Simply use the promo code A1Live, that's A1Live, for 35% off any of their challenges. As always, make sure to do your own due diligence to see that this is in fact the right firm for you if you are looking to get funded. All the information will be now dropped in the live stream chat or in the description down below. Now back to the stream. If you are a swing trader and you are looking to get funded, then check out today's video sponsor.
All right. What's going on, everybody? Tiger here. Hope you're having a wonderful hump day, or excuse me. What is today? Thursday? Wednesday? Oh my gosh, I'm losing track. Happy day. Happy rate day. That's all that really matters in this. Already had our Canada rates come out right on the dot. A little bit of hawkishness, a little bit of dovishness on that. You kind of had a few points either way. Probably slightly dovish. It really kind of just depends on who you ask. But at the end of the day, it did push dollar CAD up about 30, 35 pips or so before they started their statement, flapping their lips, and then it kind of brought it back to where it started. So that's kind of where we stand with dollar CAD. CENTCOM preparing some short wave strikes that did come out on the headline or on the bulletin board. Trump obviously to consider strikes if deal is not signed. So we are seeing a little bit of oil pushing up kind of as a result of that. So we did on oil. And guys, as always, let me know in the chat if you have any specific tickers here. I'll get my chat moved over here. But anyway, yeah, oil actually got a little bit of a push up. So on oil, since we are getting a bullish rating, I was waiting personally for either one of these two scenarios to happen. Either break the overhead supply zone, which, by the way, that looks a lot better on a 6-hour time frame. So I'll show you what that looks like. Or was it an 8-hour? I think it was an 8-hour. I guess it was a 6-hour. So yeah, just looking at it on a 6-hour, we did have a little bit of overhead consolidation before it dropped. Supply zone, kind of the way I was looking at that. So I drew this up yesterday, but I really wanted to see which scenario took place. Hey, are we going to break structure and then look for a zone of demand a little higher up the curve? Or is that zone going to push price all the way down to the next demand? So that was really the two scenarios. And so far, it's looking like the yellow might be winning out as we did get an hourly close above that overhead supply. So because it's done that, guys, I'm personally a little bit on the okay side with taking a look at a possible buy on this zone of demand right here at the $100 per barrel mark. Maybe perhaps that might be a few too many candles to the left. especially on a 4-hour time frame. That's 4, 8, 12, 16, 20. I mean, that's basically 20 hours of, you know, possibly enough time to accumulate a position if you're a bigger bank, institution, whatever the case is. But because we broke structure from here, broke the supply, and so far have gotten a close at least on the 1-hour time frame and 2-hour time frame, then I might consider this higher on the curve zone of demand because it broke that structure. So so far we got a 2-hour close. I would feel a little more comfortable if we got a 4-hour close, to be quite honest with you. So that's about another hour and a half away, give or take, which is also coincide with the rate decision that we get here in the States. So yeah, I think I'm going to refrain from getting into any trades outside of the ones I'm already in until after we get the rate release. Listen to Jerome Powell flap his lips, tell us how things are going. This perhaps will be his last one because I do think Kevin Warsh did get his nomination succeeded in the House of Representatives. From what it sounds like, now they just got to go to the Senate to pass it there. Got to jump through a whole bunch of hoops, right? So that's kind of where we stand there. Let's get my chat a little closer to home on a pop out so I can not have to strain my neck. Guys, while I'm doing this, just keep in mind you do have Nick's code for A1 Live for Ola Prime, 35% off the account of your choice. So just go to olaprime.com if you are interested in that. Holler at me at Trade Like a Tiger on all the socials if you have any questions specific to Ola Prime or just prop firms in general. I don't want to sit here and say I'm a master at understanding all of them, but I worked with the rule side of things with Ola Prime and made some recommendations while I was there. And plus, I did help on their Discord as far as helping with rules and moderating and that kind of thing. So definitely reach out to me. I'd be happy to help you out with that. And then, you've heard it the last couple of weeks. Take advantage of the Edgefinder if you haven't. The huge discount that we have going on right now, the 45% off. Get it while it's hot, ladies and gents, because it will not go any cheaper than that. I think it's worth about 10 times what Nick charges. But it, like he says all the time, it takes a lot to kind of update it, maintain it, grow that. So yeah, it's very fairly priced for what you're getting, I got to tell you. So anyway, as far as the trades I'm in, guys, you guys know I'm still in Netflix. Believe it or not, we've got really close to my stop loss, but it has so far evaded it. So let's go take a quick look. And I only point out my stocks just because the supply and demand works the same, guys. That's the whole reason I do that. So take a look at Netflix. We did chew through the rest of that demand zone that I was pointing out as far as that weekly. I've actually got a stop loss a little deeper. My stop loss basically goes right about there. So, hey, living on the edge, Aerosmith style. We're not dead yet. Okay. At the end of the day, we did chew through the zones though, and we'll see how this reacts. We'll see how this works. Okay. At this point, I could basically delete those zones, but I'll just leave them there for context. A little bit of a broken structure to the upside, I gotta say, even on this 1 hour time frame. Lower lows, lower highs. We did actually break a structure, or some would call that a change of character, right? With this green candle here and getting a close. So at this point, we have a little bit of a higher low, and now we've got another higher high. So is this going to save me after all? What do you guys think? Do you think I'm still doomed, or do you think that this is going to turn around for me and start riding those lows to the top? Either way is fine. I didn't risk a ton on this trade, just enough to put some skin in the game. And that's Netflix. And then the other one I got in was actually JP Morgan, ladies and gents. Remember, sometimes we forget this. We got the stock box over here. So if you're into stock trading, of course, Nick does have his own Trader Nick Stocks channel on YouTube. Be sure to check those videos out as well. But we got a stock box that gives us some financial readings, sentiment, technical readings as well on the top. A lot of stocks. He's got a lot of them on there. So this is why I'm getting into these trades, because I'm getting a nice bullish score on both of these, Netflix, JPM, not as much as Netflix, but real quick, I'll just show you the zones over here on JP Morgan, and we'll see what we got. So this looks very similar to Netflix, I got to say. Okay, we had a series of lower lows, lower highs. Overall, we scale out to a 4 hour. You can see that we bounced off of a zone of demand over here. So that was really kind of the basis for this trade. And then I missed the first entry because we had such a big push back up, and we started breaking some structures to the upside. So I basically looked at this as a second chance opportunity, guys. You guys have probably heard me talk about second chance opportunities a time or two. But basically, I was looking at where we bounced off that zone, kind of created a little bit of a 30-minute zone with a nice strong gap upwards. And again, we started breaking those structures to the high side. So when the market opened and that first 15 minutes of the U.S. cash open kind of settled itself, we got a bounce down into that zone of demand that newly created one I drew up. And so I went ahead and, took a trade on this. Now, I wasn't trying to get greedy on this. I basically put my take profit right up here in this area. And you can see we got close. We got close to that quick 2 to 1, 2.5 to 1, I think it was. And now we've reversed itself. So at this point, it's another potential, yet another potential second chance, because now we've bounced into another newly created zone of demand. And that's currently where we are kind of fighting as we speak. So it won't surprise me if this thing dies off, obviously, because of the rate statements coming out here shortly, or the rate statement for the dollar. But that's where we stand right now. So, just again, supply demand works the same on everything. As long as it has some decent liquidity, a lot of trading volume, trading activity, works pretty well. So at the end of the day, though, I've got my stop loss below all this, okay, below this first zone of demand that had already seen that first bounce. So that's where we stand right now. Simple 2 to 1, and that rounds up my 2 trades I am in currently. Keeping an eye on Aussie Swiss and pound dollar for some potential long opportunities. Yeah, Christian, thanks. I got somebody in my corner over there. I got somebody rooting me on. I appreciate that. Yeah, I think Netflix is fine. I mean, yeah, again, guys, take a look. It's a +9. Okay, it's a +9. So it's overall, it's looking great. Financial readings, you got a couple blemishes, but overall, pretty strong score. So definitely check out the stock box again, guys, if you are interested in stocks as well. And I'm sure the discounts will probably push over to that service as well. Okay, I think that's the case. Don't quote me on that, but it does translate to that. So Aussie Swiss, pound dollar. That's a couple of the items I'm keeping my eye on in the FX world. Obviously, let's see here, Aussie Swiss +14. And then the pound dollar is just barely bullish. Okay, so it is a +5. It's had a few blemishes of late, but it makes the cut. Must be this tall to ride this ride. Okay, it just barely, its hair just barely scraping the this tall text on the board to measure. Okay, so let's go have a look at those 2 pairs again, guys. Let me know if you have anything specific you'd like me to check out. I'll be on, and then I think we got Chris coming on right after me, so we'll get to it. Aussie Swiss, where you at? You're hiding from me. Oh, there you are. Okay. Aussie Swiss, higher highs, higher lows. Let's go get my 2 chart look. As always, 8 is above my 21 EMA, the dark red over the light red. So we're good there. Higher highs, higher lows. 8 EMA above 21. Okay, foundation. Okay. Plus, it's the most bullish. So where's my play? Well, the immediate alert I have set up is going to be on this 1-hour chart. Talking about this zone of demand right here. This demand zone kind of also incorporates this former double top going back to the 16th, okay, the 17th of April. So just about 12 days ago or so. Double top, former resistance where you had a big giant drop. So I'm looking at this as a potential odds enhancer because it is going right straight through that demand zone. Okay, if I can get that drawn up. So that's basically where my resistance point is. And again, it's kind of going at the base of the zone of demand, or actually I didn't quite get that 100% accurate. Let's do it like this. There we go. So just slightly below. So if I'm getting into this trade, if we get that pushed down a little deeper, then I would definitely want to incorporate a stop loss just a little bit lower, because you got another former resistance point just a little deeper. So what I would probably do on this is just take all these potential resistance lines into consideration. And rather than putting my stop loss just a few pips under the zone itself, I want to incorporate all that, because you just never know what's going to grab. Okay. I always place my bets on the unfilled orders from the zone, but it may go a little deeper. If I'm a bank, if I'm an institution, then I know that there's probably going to be some traders that are buying just because it's hitting that form of resistance. Again, my whole goal in life is to try to look at this in the view of a bank or an institution. If they have to have liquidity to fuel their orders to bounce the opposite side, where is that potential liquidity? So you're going to have to, if you buy this, put your stop losses below this. Okay. So potentially your stop losses with your sell orders just down below all this. Let's do this on a one chart look so it looks a little easier to see. So there you go. Okay. That's potentially what I'm looking at as far as potential liquidity, just kind of in this general area. And then on that note, I would probably, if I can grab it, even bring the stop loss just a little deeper, just incorporate all that. So that's the whole point, guys. Look for where the banks are going to attack liquidity. They can't just buy a gigantic order without getting horrible price, horrible fill. They have to layer it in. They have to accumulate. So I think that could probably be a little bit of an accumulation area for them. Talk about this red zone. And then not to mention the unfilled orders. Now, I'll be honest, I prefer seeing those liquidity grabs a little higher than my zone of demand. But in this instance, it's a little bit deeper if we're taking into account the former resistance points. So I just have to be aware of that. Just simply means, hey, give my stop loss a little more breathing room, a little more wiggle room when it comes to that. Now, I've got a choice. Let's just say I'm in this trade down here, which, by the way, we touched the 4-hour part of it. Why ain't I in the trade? Well, it's because I'm waiting for the 30-minute. This white line, just a little deeper, is my 30-minute confluence with the 2-hour. I'm actually looking at this as a 2-hour zone of demand. So we're talking about this indecision candle or doji candle, whatever you want to classify this as, where we did already wick and just bounced off already. So you can see that. But me personally, I don't like to rely on just one set of eyeballs. So that's why I went down to a 30-minute time frame within that 2-hour demand. And then I found this candle here. So that's actually a red candle, but because of my supply demand tool, it paints it green. So I turned it off. You guys can see last red candle down before the big push up on a 30. So that's my confluence point. Even though the 2 hours a little higher, I'm actually waiting on that. So yeah, it very easily could run off and leave me. That's totally fine. But that's just my confluence point. Two sets of eyeballs minimum. 30-minute, 2-hour. It's going a little deeper. I still think we could fall. Aussie didn't have the greatest numbers last night when it came to their inflation readings. When, as you can see, they were 0.2% lower on the month-over-month number, and then 0.2% lower on the year-over-year number. So Aussie did see a little bit of a decline in the context of a very strong currency in general. So this is what I personally like to see. If we have a strong currency like we do for the Aussie, which is 80%, okay, 80% of its high impact releases have exceeded expectations, then I like to see just a little bit of negative news or negative release come out for the Aussie so that it can drop price or push price down to a zone of demand. I love it. This is exactly what I like to see. So long as it's not, it'd be different if the Aussie was 50% or 60, and then it drops it into the bearish territory. But in this case, we've had strength already. And the previous Aussie inflation number, if I remember right, was actually bearish also. So in the grand scheme of the percentages, when it comes to the surprise index, it didn't change anything. But it's a brand new piece of negative data, even though the previous data was negative also. So this is exactly what I like to see, guys, because it's not changing the percentages. Still economic overperformance when it comes to the fundamentals with the Aussie dollar. So that remains really any of these Aussie plays, Aussie Swiss, Aussie yen, although I don't necessarily like Aussie yen as much personally just because the yen is the third strongest currency, 62%. So if I have my choice, I'm going to pick the Aussie and match it up with a weak currency. So Aussie Kiwi, Aussie Swissy. That's my favorite. Aussie Swiss there, and then Aussie Kiwi. It looks like that one might have actually, did that fall off our list, or did that just not populate? Okay. Oh, wait, never mind. Yeah, sometimes this happens, guys. If this ever happens, you got the Edgefinder not calculating, just add it up. Okay, so let's find Aussie Kiwi. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 minus the 2. So that's a plus 13 score. Okay, so Aussie Kiwi is right up there as well. It's right below Aussie Swiss. So Aussie Kiwi, Aussie Swiss. So we've already looked at, let's see, we've already looked at Aussie Swiss. So Aussie Kiwi, and this one still has just a little bit. Okay, still just has just a little bit of overhead supply left. It's pretty well cleaned out the rest of the daily supply. If we go back to, I believe that was the Liberation Day, low point. We've wicked through it just barely, but we haven't closed. So again, I personally require a close. I still need a close up here so that I can then look for a retracement to a demand zone. And the yellow is still, that's where I stand by. Okay, I drew this up the other day on Sunday, actually. Sunday evening, I drew that up. I said, hey, I want to see price go chew through the rest of the overhead supply. And if it does that, then it's now showing that we've got some underlying strength somewhere down here. So you guys see, I still maintain that 120.79 level as far as a retracement. 200 EMA is down there waiting for it. But I just want to see that close. So that'll make me feel a little bit better about a retracement to a buy into a demand zone. What's going on, Alan? Oh, the glasses. Yeah, you know what? I've always hated wearing glasses, but sometimes I'll wear them so I can see outside. My bedroom window is right here, so it's just nice to take a peek outside and not see blurriness, but I can't stand having them on my face all day at all. So I'll just basically walk around my house all day with no glasses, no contact or anything. Anyway, so that's Aussie Kiwi, that's Aussie Swiss. Pound dollar. Okay, another one I'm still keeping an eye on. Remember, the pound itself is just nailing it, 100% beat rate, other than I think a couple neutral items. So remember, when it comes to the neutral items, guys, I know this might confuse some of us. I know it did me at first. Neutral items are expected. So we only care about the misses or the beats when it comes to the calculation of the overall impact of that currency. So, yeah, there's no bearish items on the currency side. There is on the stock side because inflation works just a little different from the currency to the stock side of things. But as far as currency, it's 100% beat rate outside of those neutrals. So I still love pound dollar. But I won't like it so much if we start dropping bombs like President Trump mentioned over here. Okay. Trump rejects Iran's offer. Blockade stays. CENTCOM has prepared for a short wave of strikes. So that will probably strengthen the dollar again if we start getting some strikes. It hasn't happened yet, but this is them basically telling us ahead of time, yeah, we're basically going to strike them again. So that's the only thing keeping me from, really leveraging into a pound dollar long. Because if that's the case, if this happens, well, dollars are going to gain strength. We could see this thing go backwards. And then this measly +5 score is not going to look that great. So that's the only thing keeping me out of really wanting to jump in. But if I'm just looking at this thing on a technical aspect, if I'm just looking at this on the technicals, and in the short term, I've actually got a couple plays or a couple opportunities. Second chance opportunity, because we did have a zone drawn up. I drew up that broke structure. We got a retracement. We got a bounce from that zone. This was a 1 hour, 4 hour confluence. We got to push up. Okay, bounced into. It's kind of hard to see. There is a little bit of a supply zone chilling right here. Okay, we came right up to that supply zone, and then we rolled back over. So in the process of rolling back over, drop this thing down to a 30-minute time frame. This was a second chance opportunity. We got to drop in, push up, and it's kind of hard to see, so I got to go all the way down to a 5-minute, guys. This is a third chance. This is a third chance opportunity. Now, I don't know how many times I want to come back to the well in this area. Okay. So because this play was based off of this demand zone, this play was based off of, if I can get it, this demand zone. Okay. And now I'm looking for a play based off this demand zone, but they're all generally in the same area. So the one thing I drew up this morning was this overhead supply, talking about this little 5-minute area. We're getting down to the nitty gritty now. We're getting down to the noise. So I don't recommend a whole lot of you just jump down into a 5 minutes, but on this small time frame, I did see we had a newly created 5-minute demand. And then up here, fairly close, we had a 5-minute supply. So my thinking on this was, hey, and I drew it up, I might be interested. And this is probably a little more advanced, guys, so just be careful with this stuff. But I wanted to see this zone of demand break this zone of supply, get a close like we did, and then look for a retracement for a possible buy here. Now, this isn't anything I'm going to try taking up 100 pips. This is just like a little bit of a scalp opportunity. So if I know I got some demand here, if I know I've got supply here on a 5-minute, that's the extent of where I would want to make this play go to, because we didn't touch this supply yet. So I say all that to say this. If we get a drop, I personally might be looking at just a little bit of a scalp trade and then sell just ahead of this 5-minute supply zone. Don't want to like get too complicated on it, okay? But I just don't feel comfortable doing a long or like a short-term swing trade right now on pound dollar, because it is just barely tall enough to ride the ride. And then we've got the looming strikes right around the corner, potentially, as noted from CENTCOM and President Trump. So that's what I'm looking at on just a smaller time frame scale. But higher time frame scale, I'm still keeping my eye on this 4-hour demand down here, which we did not touch just yet. We got close. But think about it. These buyers, these bulls that had the strength to push price up, break some structures, they've got stop losses down here. Okay, the same thing happens right here. You see a little bit of a wick down before the bulls stepped in. So I think we're going to have some stop losses in this area as well. So I'm just going to kind of draw this box up like this. I feel like that's probably reasonably where we got some stop losses from these bulls that push price up, and then these smaller amount of bulls that push price up to this point. So I say all that to say, liquidity, unfilled orders from the demand zone, I feel like that might be a decent short-term swing style trade. And then just, make sure and wait till we kind of chew through some of these stop losses, because you guys see it all the time. A lot of times we'll pick a trade, we'll buy into a trade, and it'll stop us out, and then it'll go in our direction after all. And then we're like, what the heck? I was right, but I still lost money. Well, that's why. Liquidity sweeps. So, as far as this is concerned, I would be interested in putting a stop loss down below all this, somewhere down in this area. Okay, somewhere down in this area, possibly just take price to the top. So talk about a take profit somewhere in this area here. That's what I'm looking at. That would probably present us with about actually a pretty good, it's 130 pips, 40. That I'd probably increase that to about a 50-point stop loss, something like this. I'm not worried about any of this area down here, because I feel like it's an efficient price structure. This was our true gap down that we had on Sunday the 12th. So about 2 weeks ago, guys. Within this area here, I just feel like we got some pretty efficient price structure. There's no gaps. The point is there's no gaps. See this? That's efficient structure to me. That's efficient price action. The only major gap I saw was right here, which I've already kind of drawn up. Talking about this gap right here, okay? Proximal line of the demand zone, ignore the leg out, and we go to the bottom of the second candle. And that's where our inefficiency is. That's where demand heavily exceeded supply so much that it gapped up, and then price continued above that. So that's why I'm watching this zone here on pound dollar. And yeah, that's it. Dollar yen, double rust. Let me get a quick look at that for you, and then I think my time's just about up. Dollar yen. I think that one is a +7. So yeah, let's go have a look at that for you before I get up out of here. I think Chris is coming on right after me. Yeah, dollar yen. I still have an alert at 158.20. I just step back to my higher time frame stuff real quick on the right. 8 is above my 21 EMA. Okay, bullish, but we have to remember we've already bounced once off of this weekly. Yes, I said weekly supply zone. The daily, which is 161.25, still a little ways up. I think we still got a little room to run on this thing. And that's why I'm considering a zone of demand down here on I believe it was a 2 hour. So I am keeping an eye on this 2 hour zone of demand down here at the bottom. Talking about this candle here, a little bit of VSA activity, institutional push to the upside. I do wish, however, this price action would have broken this structure up here, but it didn't. It kind of bounced into this supply right here, got lazy for a while, but it did finally end up closing above. So that's going to be, and I'll have to elaborate more on this tomorrow. That's probably going to be my immediate interest. But the important thing is this, and that's why, and I'll leave you with this. That zone is underneath all of this nonsense to the left. If I could get my thing to work, come on. Underneath all this retail chop fest, okay? That's just a lot of retail sideways nonsense that I don't want any part of, because this is where retail traders kind of come to die in a way when it comes to their retail accounts. So I want my zone to be underneath all that, where I think more of an institutional look is. So that's why I'm looking at that. Hope that helps. Dollar yen. Let's get through all this nonsense. Don't be a victim. Don't be a stat. Look for those more extreme zones, which also coincides with a former resistance, that blue dash line. Stop loss below all that. I think you'll be fine. So, ladies and gents, that's all I got. My goodness, my time flies. Get ready, because I think Chris is coming up. Have a great rest of your day. Be safe around the rates, and we'll talk to you tomorrow.
This next segment of the live stream is proudly sponsored by the one and only Ola Prime. Ola Prime is easily one of the most impressive prop firms that I've come across, with an incredibly professional team. They offer fast payouts within 1 hour, up to 95% profit splits. They have the largest number of trading platforms. I mean, just take a look at this list. They have MetaTrader 4, MetaTrader 5, TradeLocker, DXTrade, MatchTrader, and CTrader, all available to their traders. And that's just for the Forex side. On the futures side, they have DX Futures currently, with Tradeovate and NinjaTrader coming soon. Ola Prime has one of the widest selections for challenges and funded accounts that I've come across, with a wide range of account balances you can choose from, like 5 all the way to 200K. And just take a look at the variety of different challenges you can choose from to fit your trading style. They have a 1-step or 2-step pro accounts. They have the 1-step prime, 2-step prime, direct accounts, Ola Prime, 1 challenge. I mean, you have a wide selection here. And the reason this is so important is that you as a trader have a unique style. Everyone does. And finding the right challenge to meet your criteria is very important. If you go through their website, which I encourage you to do so using the link dropped in the live stream chat right now, you can explore in full transparency all of the different account types, all of the rules, etc. They also offer news trading and weekend holding, and they have direct and challenge accounts available. For a limited time, stream viewers get extra discounts using the promo code that you see on your screen right now, and also through the link and promo code being shared in the live stream chat. Take your trading to the next level with Ola Prime. Now back to the live stream.
What's happening, everybody? Happy Wednesday. Welcome back. A little FOMC day and some major earnings today. I am just perusing through some of the gamma levels today and seeing if I can find some high-level targets. All the drama is really going to happen from 2 p.m. onwards. So we'll get into some gold, some silver. We'll get into some oil, some currencies. I'm looking at the S&P right now. Earnings this afternoon. I believe we are talking 5 of the Mag 7. I think today, tomorrow. Apple is tomorrow. Today, Google, Microsoft, Amazon, Meta, along with others, obviously. But those are the big ones as far as the big market cap up for grabs today. I do have some plays on all of them. Some of them are pending, like Microsoft is pending, Meta is pending. I'm looking for price to hopefully get me filled on an option trade. It's a broken wing butterfly. I do have some exposure in on Google and Amazon, and I have a trade on Apple as well. So we'll see if we can stay above certain key levels. Basically, for those trades, what I did is I took the expected move based on the last like 20 different earnings reports. Took that expected move, went to the downside, built out a trade that gives me no upside risk. So if we have a beat in earnings or price stays, break even or better, that should be a nice little profit for me by Friday with the Friday expirations. If we have a pullback, I have a pullback, basically pinning price right around the expected move. And hopefully that gives me profit traps of anywhere between $250 to $500 per setup. So again, Google, Microsoft, Amazon, Meta, and Apple, all for Friday expirations. We'll see how that plays out. All those earnings are today after market and tomorrow after market. For the most part, earnings have been pretty solid. I think that we are seeing profit margins increase. Profit margins are increasing in the S&P 500. We're also seeing the market reward beats in earnings versus penalizing them. So the average up move is stronger across the board than the average down move. So when a company misses earnings, it's not being penalized nearly as badly, which I think that's a good sign of where we're currently at these all-time highs or near the all-time highs. The market's been a little bit softer. Just the last couple of days, we're starting to inch lower. I don't think anybody would be terribly surprised to see a pullback towards like 7,000. I mean, I think that was the previous high. We broke above it. We got to, I think, 71.78 was our recent all-time high. But a pullback would be, I think, justified given the pace and strength that we rallied off those March 31st lows. I did take a trade this morning for Pulver Alerts on Berkshire Hathaway. Pretty safe trade, about a 95% chance of profit all the way down here towards $400. Again, this stock surprisingly not performing or not really catching up with the recent runs. I think this rotation will continue in 2026. Insurers have been beat up pretty badly. Berkshire's been stable, but just hasn't really participated in the upside move with the indexes with this recent rally in tech. So the trade that I put on for Berkshire Hathaway, you can check it out in the A1 Discord with Pulver Alerts, but it's a 410 by 400 ratio spread, and I collected about $450. So should be a good trade, about a 95% chance of profit. I'll happily own some shares of Berkshire if I need to. That's a pullback of about 26% on a stock that essentially trades a lot like the S&P 500. I say a lot. Obviously, there's a disconnect where it's not at all-time highs right now. But again, they're also sitting on a lot of cash, not participating in this recent rally that we've seen the last 3-4 weeks. Okay. Let me get some questions here. CTSH. Let me get a couple more trades in first. So these are going to be day trades. If anybody's interested, I'm going to take these trades kind of pinning some prices. I'm getting a little bit I'm anticipating this a little bit. So 40 and 50. Let me actually pin this around 45. 40 and 45. Let me see if this is a little bit cheaper to go 20 wide. That's not a terrible risk if we're coming back to that spot. I'd like to tighten it up just a little bit. Like 15 wide is pretty good. 35 to 40. That's a risk of 260, 270. Let's see if I can take this trade for like 1250 or so. 1250 is not a bad fill. 1240 is also acceptable. But I'm going to put a couple butterfly traps out there and see if we can get some FOMC love by the end of the day and try to pin some key levels. All right, 1240 got filled. I'm trying to pin a couple of prices here. One price is the 7100 zone. The other one is the 7140 to 45 zone. And I think this is more of a test. But if we come down to tests like 7060 or 7050, I've got some growing gamma down here on the option side. So here's a nice little cluster between 7060 and 7055. It's not really a pin location that I see right now. So it probably is not a trade that I should add in. That's a short-term trade. If we put a butterfly spread down here, it should be pretty cheap because that's another like 50 to 60 points lower. That's probably dirt cheap. So if I can turn that into profit, I think I'm going to. Let's look at that trade. Let's go like 70, 55, kind of split the difference. I will go 20 wide here. As long as I want it to be under like $1.50. So that trade is, oh yeah, that's super cheap. I'm going to take this trade for like a $50 to $60 risk. If I can turn this into any profit, that actually looks really, really good. So let's see if we can get this trade in for 1935 credit would be only a $65 risk. And that would be one I'd look to protect, pretty quickly. If we have price going down towards 70, 60 at all, I'll take that trade. But otherwise, I'll throw away the $75 if I'm wrong. But that offers up to like 20, almost like $1,900 in profit near the end of the day. So not getting filled at 25. Let's try 20. That's an $80 risk. All right, just got filled at 1920. So I'm basically just kind of mapping things out this morning. Key levels for me as far as where price is going to linger or maybe be near the end of the day. I'd love to see like 40 to 45. I'd love to see 7,100 and potentially in this 55 zone. So I think on the 55 one, let me see if I can turn that into a little profit. I'm going to get these organized in my broker platform, and then we'll go through some other charts. So that's 35 and 55, 35, 55, 55, and 75. So that's a low risk butterfly, 71.30, and then 45.45 and 60. And then the gamma lows of the day, we'll just say a round number. All right, so I've got a low risk fly for $80. I've got a round number fly at 7,100 for max risk of about $180. And then I have the positive negative gamma pivot point sitting around 71.45. I'll probably add another trade if I get a better sense of where the market's going this afternoon after 2 p.m. We'll have a rate decision. We'll have Powell's press conference. We'll have the Q&A. I'll start to watch some of my live gamma levels and see which one of these on the right-hand side. What I'm looking for over here is where is price likely going to start building the probability of pinning that price near the end of the day. So yesterday, that pin was really aggressive around 71.40. I had pins at 71.40, 71.35, 71.45, and 50, and made a few bucks off that, which was really nice yesterday. And we closed at 71.38. So I do like how this behaves and reacts in real time, and I just think the market needs to kind of be given the window of like, okay, FOMC is in, what's market's going to do? You know, Nick and I have talked about this in the past. Usually days like this are big indecision candle days. But given the, move that out of the way here. There's SPX. Given the look of price action so far, you know, there's a lot of open space for price to travel on the index. We know that key level around 7,000. We could bounce off 71 and stay within the range. We could come all the way down and still finish, you know, break even or better. With earnings after market, I would imagine that any softness that we see today is most likely going to be bought on dip with earnings going into tonight. So one trade I might look at while we're live, I'm not sure how long Nick and I will be live today during FOMC, but if we have a decent pullback, towards like 70.50 or 7,000 even, I may look at a bounce off that level and see if price can stay greater than 7,000 by Friday. Because if we have Wednesday earnings, Thursday's earnings, 7,000 seems to be a pretty decent pullback level. That's past resistance becoming support. If we can get a decent premium here, maybe a 1-to-1 or better, maybe. I might also structure out like an option trade that gives me a profit trap around that handle. We'll see. Okay, so that's what I'm watching for, at least short-term stuff in 0 DTE today. Let's go top down. So a couple currency trades that I'm in for my pulver alerts. I am currently looking at a trade on the Aussie New Zealand's. This is trading at 22 and change. I think this is setting up for a nice little technical rising wedge. I'm not going to short this early. Okay. I think this is a good structure trade. What I'm going to look for is if this chart line breaks around 2,100, I'm going to look at a sell trade at 2,100 and then look to sell the recent high and have trade 1, trade 2, and just try to trade this back down to a retracement fib. So this would be my 23% around 1850, and then a 30% retracement around 1700, the 38% fib around 1600. I do think it could pull back deeper than that, but if we look left, I mean, 14 to 1500 was very, very strong past resistance. And if we get a pullback here, that's probably where I plan on going. Now, I don't know how greedy I'm going to get. If I get the rising wedge break, I'm probably looking for a trade. Excuse me. I'm looking for a trade right back down to about 1850. That's a very conservative sell trade. But again, give me a structure break. Get on the right-hand side of this trend line. Let's fall, maybe 200 to 300 pips. And from there, I will start looking to buy around, I could start dollar cost averaging in around 1800 all the way down to about 1400 and then buy to go up towards the highs around 3500. Something tells me that the market's loving the Aussie compared to the New Zealand right now. And if we look left on this on a higher time frame, I am also pending orders. I haven't put these into pulver slate because they're not filled, but I'm looking to sell historical highs on the Aussie New Zealand. So looking at pending sells up here, I'm looking for a sell trade just on a rising wedge break. But honestly, after this consolidation that started in like 2014, do not be surprised if we break this move and we double that measurement move. Okay, so I'm not trying to call the top here. In fact, any dips and pullbacks really should be bought, in my opinion. If I just measure this move here from Aussie New Zealand, this is a 2014 parity low, all the way back up towards these recent highs. That's a pretty safe way to measure it right there. So let's double that move. And I think that we're looking at a kind of symmetry trade towards the like 2,700 zone. So, I mean, that's why I'm a little cautious of calling the top right now at 22, because if we do get a pullback, it is honestly, it's probably a pullback that is going to be bought, and that buy is going to continue to hit towards symmetry at 26, 2,700. So in my world, maybe the better trade is don't try to call the top here. If we go sideways or pull back, try to buy those dips, you know, support levels around 1,500, 1.15, and then try to take it up to symmetry around 26, 2,700. So you'll probably see that reflected in my pulver alerts as far as how I want to build out this trade. It might be a kind of dollar cost averaging, keep the trade size small, stack in some winning orders to the upside. But I just think as a breakout measurement, we're probably going towards 2,700. And again, all-time highs up here around 35 to 3,700. So I'm sitting up here towards these historical highs to sell, you know, 34.90 to 35.90 to 36.90, stacking in a couple of trades near those all-time highs. Okay. I'm still long on Aussie CAD. I'm looking to get to parity on this one before I look to short it. Aussie CAD I like a lot. New Zealand CAD I'm also long. This one I will continue to buy more. If we have New Zealand CAD, let me check my account here. New Zealand CAD. So I'm going to keep buying this bad boy. Right now, let me check CB rates really quickly. I want to say the New Zealand CAD should be a positive swap. So cbrates.com. New Zealand is 2.25, Canada 2.25. So it should be zero swap on that, which is fine. Bank of Canada kept rates steady today. This one, I'm going to, basically, I'm just going to continue to buy it. If I take another chunk here, one position, buy the lows, dollar cost average in. You know, even if this gets worse, I'm still going to trade this larger range. These are currency pairs that I let robots trade. These are currency pairs that I do not mind, you know, dollar cost averaging into, because they're very, very efficient currency pairs. So if I'm right, then I buy the position now and it heads up to the top of this range, probably like 8,400-ish, 8,500 before I take some profit. And trading around under 8,000, you know, there's 400 to 500 pips to the upside on this trade. So that's what I'm going to do. I'm actually take this trade right now. If you're interested, I'll throw the levels in. Let me go to the weekly chart, get my key levels. So I'm going to buy right now. Pretty low margin on New Zealand CAD. I'll get 3 levels in. I'm going to buy now at market. I'll buy again around 78.40. Write this down. So market's going to be 79.76. Again, you got to trade small because I'm going to dollar cost average into this. 79.76 and around the 78.40 zone. We have lows down here at 76.50. I think that's good to start with, is 3 levels. And then take profit's going to be somewhere around 8,400. So destination to, you know, let's say 83.50 to 8,400. Take some profit, stack this thing up. No swap, which is fine. I don't want it to cost me anything. You know, the broker might be sneaky and cost me like less than $1, less than, you know, 50 cents a day or something if they're slimy. But I'll find out once I see some daily transaction fees. Hopefully there's none for New Zealand CAD. All right, I'm going to take a stab here and buy this thing. So buying the New Zealand CAD. Let's go buy at market. Okay, putting it in. I'm going to trade $1 pip and scale in. I'm going to use different trade sizes. So I'll do $1 pip and like $1.10, $1.20, so that way I can close them out non-FIFO. But I'm going to buy this at market. Take profit price is going to be 8,400. I'll go 83.90. Top of the range is around 85. I could probably be going towards 85. I'm just going to go 8,400. That's fine. That's still, you know, 400 pips. So we'll try for something like that. Submit. Trade is in. Okay. Next level. This is going to be a pending buy. And pending buy at 78.40. No expiration. Take profit. 83.90. Pending order. And then I've got lows on my broker platform, 76.35. I'll go 76.55. 76.55. $76.55. That's testing those lows. No expiration. 83.90. Take profit. All right. So collectively, those 3 positions, if we end up getting filled, let's say we get filled on all 3 of them. Well, my break even is going to be somewhere close to about 7,800. I'm looking at a move that my stop loss is going to be just a little bit below 76. I don't think price is going too much lower than 76 if it even gets there. To me, there's still a structure trade in here where this low to high, all of this is consolidation. And so we're either going from a low high to then have a bigger move to the upside, or we are in this larger channel. This comes down and tests the lows, right? Test the lows for an equal level of support, or it breaks and we just have a larger channel. I'm going to buy more, probably around that 7,200 handle as well. Okay. But my goal is, if I'm adding more to the downside and price comes back to the middle of this channel and I'm in profit, I'll take profit early. But if it holds this area, goes up to 8,400, obviously I'm taking profit at 8,400. Okay. All right. So I'm going to take that trade. That is 1 market order and 2 pending orders. And I'll put down the, I think 74 and 72. I'll trade those as well. I'll sit in those a little bit longer. 74. So 7,400. And 70 lows I have here. Channel lows are on 72. I'll go 72.50. Limit by 72.55. Okay. So basically what I'm doing is grid trading this thing. So I'm buying. So I'm going to work this area. And again, you can see that I'm stacking up trades lower. If we come back to 1 entry, 2 entries, 3 entries, if this level holds and we go back up to the top of the channel, I'm taking profit. If we come down to these lows, we get back to the halfway point of the channel, I'll take losses here, take winners here. I'll still take profit. I'll work through the trade. Drawdown wise, for $1 each, I'll be down. if I get filled in all those positions, that's 5 orders. I'll be in for less than half a standard lot, or right around a half a standard lot. I could probably stomach a couple $1,000 drawdown here. That's not the end of the world. I'd be down maybe a couple $1,000 and probably turn that into a positive. If I'm down $2,000, I'll probably make $2,000 to $5,000 on the upside. I just need to kind of be patient on this setup. Okay, so yeah, it's definitely. It's not, that type of trade is not for everybody. That's the way that I manage a currency fund for years. I trade really boring. I trade really big levels. I trade huge structure, and I'm very, very patient. So, you can see here that since 2016, this thing has been in a down channel. So I want to respect that. But at the same time, every time we've tested this low, we have had a significant bounce off of it, which is why I'm going to plan, basically patterning out my trade that way, where I don't have to have a stop loss like, I'm going to stop out, right below this yellow box. Why? I'd rather hold the trade with no swap and still have the thing pay me with the higher probability of finding support at some point, right? So either support is now off of this, swing at 7,600, or we end up finding channel lows and I just dollar cost average in, buy more, buy small, stay in the game, manage a drawdown. And then the nice part is I've got a video on this on my YouTube channel, adding to winning positions. If I dollar cost average in for a couple of key levels, and all of a sudden I get a nice bottoming pattern here, I start stacking in winning trades and I start adding more and more and more when the thing's going my way. That's how I can turn like a $2,000 drawdown into like $5,000, $6,000, $7,000 in profit. So everyone looks at, my equity management as well. You don't have a stop loss, right? But I have a percentage amount and a dollar amount that I'm comfortable risking. And this is why I trade really, really small, because I like to add to my winners. And not a lot of people do that. So that's what I like to do. All right. Thanks, Moses. Appreciate that. Everyone's asking for the yen. Look, I try to talk myself into selling the Swiss yen today. I can't do it. I like the trade. Okay. But I still go back to, I've traded currency since 2007. The yen's been very good and very evil to me at the same time. I made a lot of money in 2011, 2012. I lost a lot of money in 2022. I basically had to hedge myself out of yen crosses in 2022. I was long the dollar. I was, long certain yen pairs and short certain yen pairs. And I battled the dollar yen and the Swiss yen like an idiot for like 6 months. Anyway, the currency drives me crazy. This technically looks like a pretty good setup. We have clearly a top here. It's historical highs, but there's no context to this Japanese yen. You know, the BOJ intervention, I know everyone's looking at this, right? But do not think for a second that this market is like, yep, BOJ's got her back. Man, you have no clue what this BOJ plans on doing. They might do nothing. All I'm seeing is that the BOJ is going to continue to let inflation run a little bit higher and tick a little bit higher. Their Japanese government bonds, they're going up in yields. Okay. So, I mean, the currency is getting weaker. Their indexes, their Nikkei is getting stronger. Like it's going to all-time highs. But I just think, I don't know. I mean, obviously they can step in and play a lot with their currencies. They can intervene. Maybe it's that 161 level. Maybe it's that 162. That's 40-year weakness on the Japanese yen. But if you go back to 1970s, the Japanese yen versus the dollar was up to 200. So don't think that this is a top. It doesn't have to be a top. Yes, it could make sense to sell, but do not call this top. So what I'm thinking of on the Swiss yen is this is one of the only currency pairs you can short. So you can short the Swiss yen and not get charged to short it because the Swiss is at 0% and the BOJ is around 0.75, right? Here's central banks. Japan is at 0.75. Their last rate hike was December 2025. Now, they are talking about maybe raising rates again to possibly 1%. Will that be an unravel in the carry trade? I don't know. Maybe. Everyone's just kind of narrowing the gaps anyway. I mean, the U.S. is down to 3.5, 3.75. A lot of central banks have been cutting rates recently. Aussie just raised rates by 25 basis points, which is why I think the Aussie is getting a lot of love compared to New Zealand, which is fine. Anyway, long story short is I just don't trust the yen that much. And so if I'm going to take a trade on Swiss yen, couple things. If I wanted to take the trade now, okay, this is what I would do. I would take a small trade here. And then at the high, I'd probably take a second small trade. And I would go 1 or 200% ATRs above that, which is probably going to be a stop loss around 206. If this level does not hold, I do not want to be holding short. I'll take the loss. But if I'm right on this trade and this is a range and we go all the way back down to this low, well, we have limited risk to the upside. We have a lot more potential reward to the downside. And even if it comes down to find the range lows or this 200-day moving average, I mean, we're talking a move from let's say 203, let's round to 203, all the way down to 198. You know, that's 500 pips. And my risk is maybe 300 to 400 pips right here as far as playing out the space. So if I take one trade that pays me, great. If I take two trades and I don't get stopped out, all of a sudden my dollar cost averaging is going to be, let's say here around 203. Now we're talking 500 pips for a risk of about 300 pips. So, you know, I set it up in a way that's favorable, but I have to admit that above 206, I don't like the trade. Okay. And if you want to take this a step further, are there any other correlations with these yen crosses? A lot of times the yen moves in a basket, right? The yen basket moves aggressively strong together, aggressively weak together. The Swiss is the only one that looks like a good setup. You go to euro yen, it's not even close to the right side of the trend line. You go to pound yen, not even close to the right side of the trend line. You go to CAD yen, not even close to the right side of the trend line, and it's making higher lows. You go to the euro yen. I did that one already. New Zealand yen. Okay, same thing here. Go to Aussie yen. Right? Like none of these look like they're ready to sell. So essentially you have the dollar Swiss, which is like, okay, I'm looking left. 162 is major resistance. Is it though? It might be, but do we have to see resistance because of intervention? Or if market forces just do their thing, I don't know if the top is in at 162. You know, I don't think this trade gets good for anybody unless it's on the right-hand side of this channel and it's making lower highs and lower lows. And it's just structure has to tell us that. I think guessing and calling the top up here is it's going to be a guess. It's hard. It's hard to know. So if you have risk defined trades, so be it. But if you're trying to, you know, call the top and scale your way through this, all you're going to do is cost yourself money every single day holding a position that doesn't want to move, right? There's so little movement in these crosses. Eventually we'll have a big move. And maybe it's that. Maybe it's a huge range trade. But I'd rather just pay attention to selling over here with sell stops on the way down than trying to call the freaking top right now. I don't think anybody knows. Okay. So like I said, Swiss yen looks like a good setup. Dollar yen looks like we're close to a good setup, but Aussie yen's at highs. CAD yen is near highs. Euro yen, pound yen, New Zealand yen. None of them look like they want to sell off. So as a basket, I don't have a good setup on the yen cross. I'll pay attention. I'll watch chart alarms, but I don't have a good setup on the yen crosses. Okay, dollar index. A lot of people wonder where the dollar is going to go. I think it's range bound. You know, if we break above here on the dollar, it's going to be risk off in the equities market, in my opinion. If we, break lower, it's risk on. But I think that really this probably doesn't happen, and this doesn't happen without a sell off in the market. I really think the dollar index is going to continue to stay range bound from about 96 to 101. A 500-point range on the DXY. Trade accordingly. So do I have a position right now? No. If I want to buy it, I buy it at 96. I want to sell it. I sell it around the 100.50, the 101, and stop loss immediately above that. Because if I'm right, there is your high reward, low risk trade, right? Or if it's down here, high reward, low risk trade. That to me is a better setup on DXY related pairs. Okay. All right. Gold. Here I'm at on gold. I am bullish on gold. Big picture. Okay. I think after this crazy run, we've seen a 3-4 year bull market since COVID. We had a really strong run since the deleveraging in 2022. There's those really nice lows. That's where I started my fib. We have this huge run on gold. I think that gold right now is intentionally boring for everybody, and that's fine. Big pockets will continue to dollar cost average into gold, and it will maintain a bid. Now, here's what I'm going to do. I already have lots and lots of option trades down here on gold to hold to 2027, 2028. And forever, essentially, because I'm going to do, ownership of GLD. I'll take my stabs on income with GC futures, and I'll take trades on CEF and PHYS. And there's one other ticker that I trade, GLDM, are my kind of gold and silver exposure tickers. But look at this structure right now. I don't think it surprised me at all if we connect the lows and we connect the highs and we see that gold does something like this. Okay. It's not going to be perfect, but I wouldn't be surprised if we make fresh lows, come back to about 4,000 here, maybe 3,800. Okay. If it wants to really rattle the cage and everyone that's bullish on gold, it comes down to maybe this level, this breakout point around 3,400. I'm literally a buyer at every single level. And I'm not going to care. Like, I'm going to buy it and I'm going to hold it, and it's going to be a long-term trade. And eventually we'll get back up to 5,600. And that's a great trade. But it's not a time trade for me. It is like, I will add it to the portfolio, allocate 5, 10, 15% of my portfolio to gold, and that's a trade I'll buy and hold. Because eventually, if I'm right on that trade, let's say we just hit 3,800. If we go back to all-time highs from here, I take a gold portfolio and it goes up 40%. I'm pretty happy with that. Okay. So I am looking to add options exposure. I've already put ratio spreads in for pulver alerts. I'm looking to buy more shares. If I'm buying GLD, I will basically dollar cost average all the way down to about 320. Okay. And that would be a pretty substantial pullback from this big retail high we saw here. That would be, about a 37% correction in gold. I mean, I'm sure it could be worse. It could be a lot worse. But again, go back to the structure: high, low, lower, high, lower, low, lower, high, lower, low. Don't be surprised if it does that, because it's going to shake out and rattle all the loose hands that, everyone's chasing. They got stuck with it as a bag holder at the top. Now they're trying to buy and take every buy to get back to these highs. It's just going to take time. It's going to bore everyone to death. But eventually, all the money accumulation is going to be down here. And, it'll trough out and eventually work its way back up. And once we break these highs, we're probably going to, I think spot price could go to 7,000, 6,500, 7,500. People are talking about 10,000 in the next 5 years. Okay, cool. I'd love to be in that trade. If I own gold at 4,000 spot price and it goes to 10,000, that's 100% plus, right? That's 150% return on gold. I'll take that trade all day, right? All right. So that's big picture for gold. Am I trading the small time frame stuff for FOMC today? No. All it is noise. FOMC is noise. If you're trying to trade today, look, the trade I'm taking today, it's based on indexes. It's based on pin prices. That's all I'm doing for today. Okay. If somehow I'm going to throw a small risk in here, if we get to like 71.85, I'll take another trade up here. I'm going to throw about 4 profit traps in today. We'll go 80. I'll go 85, 20 wide. See what that looks like. 85, 20 wide, be 05 there. So that's a $50 risk. I'm going to take this trade for 1950. I'll throw in a small risk on this one. So I got like 4 profit traps out there. Credit 1940 cost me $60 in for 1940. All right. So my levels for today, I can let price do whatever it wants for the entire day. If by 3:30 p.m., 3:45 p.m., 4 p.m., we're close to this level, 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 each one of these trades is offering like, I don't know. I mean, some of them are offering 10 to 1. These are offering almost 10 to 1. These are offering like 5 to 1. So those are great. And I don't need to be right on all of them. I could literally lose 3 of them, win 1 of them, and walk away with a couple $100 today. So we'll see. These tend to be just pretty sticky levels throughout the day. So we'll figure out where price wants to go ultimately. I think we're going to somehow just kind of stay boring, maybe shoot down to 71, shoot back up to the midpoint, and just kind of hang out with a nothing burger type day, which is what FOMC typically is noise, right? So if you're in trades right now and you are going to be exposed to the 2 p.m. to 4 p.m. window for the markets to move, look, one thing about FOMC is everything likes to have an excuse to move. It might be exciting and crazy volatile today. I would say that most of the volatility is going to open up Thursday and Friday. So if you're looking for some flows, if you're a futures trader, I would trade Thursday, Friday versus today. Trying to pinpoint something within a couple of hours, it's not worth it. It's going to be better after market. It's going to be better during the futures market hours to see where the market's going to take the post FOMC close. Does it run the market higher? Does it run the market down? We'll have earnings to come in as well. And we'll see what futures market looks like for tomorrow. Right. So Thursday, Friday should be a good scalping day if you're interested in some direction. I think that you'll get better movement flows on Thursday and Friday. Also, it's the end of the month on Thursday. So end of the month plus all the earnings plus FOMC plus PCE tomorrow. The market's kind of stacked up with a end of the month fireworks. Fair. Okay. So we did a little gold. Let's go oil. Let me change this ticker back here. Let's go oil. Okay. How is the market not down more? I think that we've already seen the market's willingness to call, basically the market's like, look, we get it. There's pressure on stocks, but it's kind of looking past everything in oil right now. I think oil is crazy volatile. I'd be way more concerned, right? I'd be way more concerned if we break above 120 because we're probably going to have a crazy squeeze. That has to put a lot of pressure on the equities market if we do that. Update to NukiTrade Pro indicator. So are you talking the Pro indicator on TradingView, Bulent, or are you talking the web app? So the web app is what I use like every single day for real time. I know there's a way to get the update. Is it a code update? I actually just talked to their team yesterday, so I'll make sure I have the right indicator. I'll ask. Indicator. Okay, so the one on TradingView. Yeah, that's fine. I mean, this one, they were limited to this thing only updating like 5 times a day. That's why I use their live web app. This one I use a lot more as far as like spot checks, whether it's chart levels. I love this like absolute Gex that gives me those pin levels for the day. So, literally I have pin prices all over the place. Pin price up here. Pin price right in here. Pin price at 71. And pin price at 70, 60. So there's weakness in there. I mean, obviously, if the market wants to slip in between them, I have some risk. But for the entire day, I'm maybe risking like $500 or $600. If any one of these lands, it would be $1,500 to $2,000 of profit. So it's decent setup as far as reward to risk. If I get one of these to pin up, then I'll. But yeah, I'll get with the team, make sure I have the right TradingView indicator. Okay, let's go to oil. Who's trading oil, by the way? Is anybody scalping oil? If so, I mean, I guess keep doing it. It's been pretty fantastic. We had our crazy correction. I kind of called this top of that Gartley pattern. I did some broken wing butterflies down here that worked out really well. I called this low around $76. Gave me a few $100 there. I have not been scalping this to the upside. And the reason why is because I think this is still range bound. And so whatever happens in here, I could see oil at some point just kind of working its way back up, topping out, working its way back down, and we'll just figure out what range oil wants to trade in. The scarier part is if we break above 120, I'm clearly concerned that we're going to have a much bigger scare of inflation than everyone wants, right? So I think right now everything in Iran, everything in the Middle East is brinksmanship. I think it's noise. I don't think the market really cares as much as it once did. Trump is not nearly as vocal about it right now, but the commodity itself it's moving. It's highly volatile. On that note, let me check something really quickly on oil futures. The Ivy rank, when I started selling premium on this, was up to 99. Now the Ivy rank is at 51. So it's not nearly as juicy as it once was. Okay. If I go down to, $79, I am curious, and I don't know if this is a good trade, but if I went down to say, okay, we can't go above 70, let's say we can't go above 120. Okay. So in the next, let's say end of May. What's end of May? I've got May 22nd futures contract, June 1, $33. Okay, so spot price here is 100. Spot price here is 107. Let me see what the 120, 125. I mean, this is way up here. These are pretty high deltas. I really don't like these trades. These strikes kind of suck. So if I did that's 250 by 3, this might be okay. Probably not, though. That's a debit. So that's a 250 profit trap. That's $2,500. That's a 1-to-1, but I'm getting paid $140 to take this trade. If price is above 120, my break even on this trade is 122.50, which is above the highs, but I really don't want to risk 23.60 if I'm wrong. Okay. I'm almost wondering if I could do a call ratio back spread on this and try to get some profit to the upside. Let me see if I can do that. This will be interesting. So if I buy June 1, so I want to sell the 100, which is kind of at the money. I get a little bit more premium for that. So I sell the 100 and I will buy 2. Ugh, that's just expensive. So yeah, this is really pricey. I mean, I could cap this move and say 100 by 110. Sell the strikes up here. That caps my upside. Takes the debit down a little bit. But I mean that trims my loss my loss like $8,000 or $9,000 to $3,500. That's still a lot of risk. That trims me to under 2K. If price goes down, I want this to be a credit if possible. And I think that's going to make the dead zone too big. Yeah, I just don't like the trade. It's just high volatility, Maybe it's better down here, and I say that we stay above, 76. Let's try it. So we stay above 76. Buy the 77, sell the 75, put in a broken wing. That's $190 of profit. That's not a bad trade, about a 96% chance of profit. This is only out to June 1st. Do we think that price is going to come down that much in 33 days? Is oil going to drop? I mean, anything is possible, but is oil going to drop 28% in 33 days? Thoughts? I don't know. I don't like that trade. It's too risky. If this is a higher credit, maybe. Let's see if I got in for 50 cents. That's probably not going to fill though. But that would give me, $500 of profit, risking 2 to make a profit trap of 3,000 at those lows. I would just need oil to drop. If oil drops and we start to get these premiums up a little bit more, I think I'm just going to stay out, and I'll just be a spectator here. I think watching the fireworks in oil, unless you're scalping oil, have at it. But I'll pass. Otherwise, if the Ivy rank was higher, I would just do out of the money iron condors. I'd sell premium up here, sell premium down here, but the Ivy rank is been basically cut in half. So I'll hold off. All right, oil. What's everyone's outlook? I'm always curious to ask. Everyone thinks that oil is going to go to $200. That's not my trade. I think this market likely will keep oil pretty contained, less than 120, but probably higher than 80. And this is our new normal. Okay. Once we kind of fix things or have some resolution, then I can see oil, heading back down. But again, 80 to 75 seems pretty sticky with all the infrastructure destroyed during these conflicts. So, what up, Nick?
Hey, Chris, how are you, man?
Good, man. Nice to see you.
What do you think about oil? How far can it go?
Well, I think that I hear a lot of people telling me, they list all these things, and it's like, I hear you, but I don't think the market cares that much. If the market cares, I mean, dude, oil from this recent low, oil is up 36%, and we just hit all-time highs in the last couple of days. So the market's not, I mean, that correlation of, oil's up, markets are down, it's not working right now. And so I think the market is just kind of letting volatility rule the day. But our IV rank's been cut in half. So I'm really I'm done selling premium on oil. I don't think I can really get a low risk, high reward setup unless I'm scalping. So I'm just going to stay. I think 120 is probably the top. I think we range bound from there. But I think it's just going to be an ugly, volatile range for a minute, probably the next few months.
The other question I have, I mean, to your point there about oil went from center stage, everyone pretty much started their day looking at oil and then looked at everything else. So now it feels like people have moved on to semiconductors. At
Very
least
true.
Recently, that's the, if semiconductors are up, then it doesn't matter what else is going on. It seems like that kind of just drags the market higher. We've had the Nasdaq get a little bit of a breakout going here recently, of course, carried higher by semis. IGV has done okay here recently. We're holding together, at least stopped the bleeding for now. S&P 500 is new highs. Where are you feeling with everything, Chris? I mean, for me, I would actually say oil prices here probably should still have the market's attention. I mean, they were all the worry over here,
right?
And now, on a day where oil is jumping a cool 7.25%, and markets are hardly phased.
Right.
I guess obviously you're waiting right now for earnings this evening, and of course the Fed meeting today. That does also matter, but you have a lot of pent up energy on the earnings front as well, with 4 of the Magnificent 7 reporting their earnings after the bell. But I mean, expectations are high, Chris, and you also have oil rising. I heard you say it's not my trade on betting on oil continuation. I kind of am there with you too. But the other trade that's not my trade is trying to bet hardcore long on indices right now, because again, you just have
I love a pullback.
Yeah, got a very pent up. Things could go wrong, I would say, easier than they could go right. Even maybe not necessarily that they could go. It's just that if they go wrong in any capacity in earnings, you have downside risk that I think it's much bigger.
Yeah, I still think it's a buy the dip. I think the markets are still loving, this rally kind of gave the markets permission to say, okay, everything's going to be fine. We are rewarding companies that are beating earnings more so than we are penalizing companies that are missing earnings. Mag 7 probably will beat earnings. Unless they really harp on how much they're going to spend. I mean, Microsoft is offering one of the biggest buyouts from their employees ever. 7% of the workforce is like, retire, here's money, get out of our company. We're going to spend this on AI. It's like, that's happening. But if tokenization and NVIDIA is going to all-time highs and semiconductors are at all-time highs, it's a weird space, but we are getting heavily concentrated in AI. But Nick, you also have some of the largest IPOs to ever come to the markets this summer. June and July, it's like if we have SpaceX IPO, Anthropic, or OpenAI, any of those go public in June or July, the CBOE is going to benefit. Banks are going to benefit. Financials probably benefit. I just think there's enough resiliency to kind of still keep this market baked in for a pretty resilient, 2026. And once we get through a decent earnings season, for the most part, everyone's consensus-wise, people are beating earnings, which is good. Like I said, the high side is being rewarded more so. I mean, look, dude, we had Visa jump almost double the expected earnings move, almost double. Coca-Cola was supposed to be like a 2.3% move. It jumped up 4.5%, almost 5%. So the upside thrust is much more aggressive than the downside pokes. And so trades on Meta, which again surged off these lows after they dumped $84 billion in the metaverse and decided they're going to cut it loose. I'm trading Meta, but I have no upside risk, because if we start to reignite the upside, look at where we are on the daily time frame, by the way. Okay, we have been kind of playing tag with this 200-day moving average for months now. October, November last year, we got below it, back above it, back below it, up above it. It's pretty critical spot. If we stay above it, Meta probably puts in the low for the year, and we're going to draw some type of channel, and we're going to continue to see, maybe Mag 7 again. outperforms. And it's no longer the lag 7 when there's catch-up trades, because Microsoft and Meta have been the laggies of those. Apple's near all-time highs. NVIDIA is at all-time highs. Google's at all-time highs. I said Apple already. Tesla, not sucking, but not great. But Tesla also is going to get some love from SpaceX. And if they do humanoids later this year, you know, they're probably going to get some love as a tech company, not just a car company. Anyway, a lot of premiums on Tesla. So yeah, again, I'll ask you this. I don't know if 6,300 is the low of the year, but I would say that we're probably not going to come back and close below 6,000. I think the market's going to have enough resiliency after this Q1 pivot that we're just going to try to defend. We'll resiliently defend the markets. Maybe it's a lackluster, 7, 8, 9% for the year, 10% for the year if we're lucky. But it's enough to kind of cling to these highs and levels and not have all the dispersion and worry that we had earlier in the year.
Yeah, Chris, I've actually got shares of Visa, which was awesome to see that.
Visa, okay, nice.
Huge jump. I've got Meta, I've got Amazon. So I'm kind of clinging on to some of the names, some of the big leaders. Like I'm just keeping them sitting in the portfolio. I've got nothing. I felt like I also bought Intuitive Surgical today. That's a brand new holding for me. It's a company I like for the long term. I also bought into it during the dip. So I've been selectively picking my spots. I'm also, like I said, long Meta. So I've got a whole bunch of different, the Mag 7 Amazon has been a monster here recently.
Yep.
And I think that can continue. I think that to the point that you made about Mag 7 maybe leading again, at the end of the day, I think that's where people have found almost like the stability factor in, is like going right back to the Mag 7 every single time.
Right.
They have the earnings, they have the the growth to a capacity. I guess Mag 7 has slowed a little bit in its earnings, but still, it's like, what are your alternatives? Do you want to go international? There's some spots there that are decent. Do you want to go small cap, mid cap? I think that this market has just been trained very well to buy the dip on the big players. So anyways, I think that when it comes to indices, I am interested in buying the dip as well. I'm looking at this 7,000 level as a, retest kind of area on the S&P 500.
Yep.
I'm watching the Nasdaq, same kind of story. But yeah, I think creative, directional, defined risk type trades for me are very much attractive if you were to get a pullback. I think you've got a situation where, yes, there's still Iran headlines coming out, and maybe that starts to spook markets again. But we've seen this story so many times, Chris, where you get this new narrative and it spooks everyone. And then once it starts to like diminish in its effect on the market, people still kind of try to cling on to it for a long time, but it just keeps losing its ability to scare the market. It's like a ghost. If you keep seeing it, it's no longer scary. It's like in scary movies, right? They purposely don't show you the scary thing, because once you see it, it's no longer as scary. So anyways, S&P 500 pullbacks on indices to me still look attractive. What are your thoughts on like things like Bitcoin? Do you think there's alpha to be generated buying a Bitcoin that's down 40% off the highs while S&P is at the all-time highs? Like, if you're thinking S&P 500 keeps kind of flowing higher, could a risk asset like Bitcoin be a good risk reward type setup?
Not yet.
Okay.
I think it's going to get better if we crack under 50 or 40. I think Bitcoin's a lot better setup than it is now.
Okay.
I hate to say that, but I don't think that the market's at all-time highs and Bitcoin not really chasing this or following through to correlate with that. I don't think Bitcoin's got a chance of going back to 130K without cracking maybe 50 or 40 or 30 and really scaring off everybody. And everyone's going to say, I told you it's going to zero. And then 30K is going to go back to 130 or 140, 150. And there's your 4 to 5X move. Historically, we've had 70, 80% pullbacks. I think that's the same type of thing. It's just a bigger price tag. So if we pull back, 70+%, we're talking 35 or 30K Bitcoin spot price. Dude, I'll take a stab, and it'll be the same thing. The crazy part is you're getting a huge reset there, right? Like 130,000 down to 30,000 feels terrible, but a 30,000 position, if you could dollar cost average and build the base back up around like low 40s or mid 30s, I mean, 30K to 150 is a pretty attractive trade. So as far as generating alpha, that's the trade that I want, is kind of letting everyone get scared out of it. Everyone can say it's going to zero. I'll buy, a fixed amount at 30 to 35K if it gets there, and try to take it back to all-time highs. And there's a 400 to 500% gain. So that's my trade.
Fair enough.
I still hold it. I'm in it. I'm still holding it. I'm just selling premium, and here's what I'm doing. I'm selling premium on about 80% of my ownership of Bitcoin,
Mhm.
and the other 20% is running. So I'll just kind of dollar cost average in, but I do not want my base price to continue to go up. Like
Are
I
you
want to
doing
lower my cost basis.
IBIT primarily?
IBIT
Okay.
and FBTC, those are the two that I
Okay.
primarily trade.
Yeah. I'll diverge with you on that a little bit. I think Bitcoin from and this is not necessarily in contrast to what you say. I just think like in the short run, if we're going to see risk assets keep going on a run, let's say we get a little bit more of a pullback across risk assets the next few days, weeks.
Yep.
I do think that the rallies breakout can sustain itself, and I think that maybe Bitcoin
The all-time highs, though.
Maybe not.
I think we kiss 100 and we fail. That's so I've looked at
Okay.
this pattern many times.
Yes.
If this is a high to low, I think we're setting up a flat pattern, and the bait is here's your low,
Mhm.
there's your pullback. We sucker everyone in thinking 100K is the mark, and then we fail. That's what I think. So
Yeah.
I will be getting rid of some of my risk in here, probably just to be on the safer side, because I'd still like to buy it lower. If I don't get it here and it goes higher, obviously I'm going to trim some risk and still get some gains. But like I said, we talked about this earlier. When this thing's down 40 to 50%, I'm treating it like a trade. Bitcoin is not the end all be all. It's not the greatest thing ever. I mean, dude, Claude was basically wiped out in 9 minutes yesterday from an AI agent. Like, Bitcoin is not unhackable. Bitcoin is not foolproof. It's like, it's just a trade. And I want to treat it like that. You know, it's a good investment to have. It's you know, asymmetric, I think, in the big picture. But there has to be, you know, a lot of things to have to go right with it. And I don't know. It's just, I just think you can't treat it like, I'm not orange pilled like a lot of other people. I'm going to treat it like a trade.
Yeah. Chris, what about gold? Gold's been actually kind of starting to pique my interest a little bit more than last time we spoke, I think.
Yep.
Simply because I did do some, let me see, what did I do on this? I did GDX short puts down at $83 a share out until end of May. So 1 month from today, there's a good chance I could actually get assigned on this.
Okay.
And I'm not complaining at all if that happens, to be honest. Like, I've got this longer term level on GDX.
Yep.
I wouldn't mind holding some shares of GDX. I think that this can appreciate over time personally.
Sure.
We're getting some oversold readings. You've got longer term levels of support getting tagged there. I do think that gold, I mean, I could trade GLD. I just chose GDX, a little bit more premium in the trade. Of course, I'm seeing why right now with this thing moving a lot more than gold. But I think that there is still a longer term bull case for gold that can continue. National debts are still on the rise. And maybe one of the biggest concerns for me still on gold stuff is still that persistent rise in the 10-year yield. I think that for Japan, right? We've talked about this off and on, but it just quietly keeps going higher, Chris. And I wonder at what point when the market pays attention to it again.
I don't know, man. I think that I talked about that a little bit earlier. I mean, the Japanese yen as a basket is always a tricky one in currencies, but watching the yields go higher, watching the BOJ basically sit on their hands and let inflation run a little bit hotter, not really trying to intervene. I just don't think that any currency pair on the Japanese yen is set up for like a basket sell. I think that individually, Swiss yen's at all-time highs. Dollar yen is at those intervention levels around 160 to 161. 162 is a recent high when they really stepped in. But if they do nothing, I mean, think about how many people are selling, hoping that 162 is not breached on the dollar yen. Tons of people. So guess what? The market's probably going to reach for that liquidity and maybe go to 163 to 165 before it puts in a topping pattern and just to do a liquidity grab at those highs. So, dude, it's the most radical central bank in the world. I never know what the big picture is, because when it does move, it's like jump on the tsunami and ride it for as long as you possibly can by break-even stop losses. But do not try to call a top or bottom on the Japanese yen, because, dude, I don't know what the yen's going to do. If the yields keep going higher, cool. I don't care. If the Nikkei wants to go higher, great. I'm long the Nikkei. But that could be like the 2024 little summer scare we had with that carry trade unraveling. We're no better off than where we are.
I've got to say, the Japanese yen has got to be the hardest currency, in my opinion, and in your opinion. I'm pretty sure, just from our past conversations.
I hate it, man. I hate it.
Look at this. This is crazy. So the yen, to your point, it's fighting. The Bank of Japan is fighting rising inflation. Central banks, commitment of traders data. I thought this was interesting too. Look how persistent, and this trade has been such a winner for big money. institutions have just built a bigger and a bigger short position on the yen for like the better half of a full year.
Mhm.
And that has been such a winning trade. I mean, think about, big players at the table, just short yen, short yen, short yen.
Yep.
And it's almost been like a trap in the sense that, first of all, the yen, like it's like a value trap almost in currency land, because you have this situation where if we go economic heat map, like there's a case to be made for yen strength just on the macro. Like if we look at GDP growth, that's not particularly attractive, but they still have a positive surprise in GDP numbers. I mean, they've been dealing with like no growth forever, so let's kind of factor that in. We had a positive surprise on GDP numbers. PMIs have been strong. Services PMIs have been strong. CPI surprised upwards, or it went up to 1.5%, which I know is low relatively speaking, but 2.6 for PPI. This is a place that experiences historically very low levels of inflation, low levels of unemployment, and low levels of growth. The story's changing, right? Where you have unemployment rate also slightly on the rise. And so there is this case that on the inflation front, that challenge, that the Bank of Japan would hike interest rates. I mean, made abundantly clear by the idea that just look at the Japanese 10-year yield and it just going up and up and up. And this is, typically where central banks will hike rates. And there is the expectation that the central bank will hike. It's just that people think in the market land, it seems like they're going to hike interest rates too slow. And so that slow, cautious rate hiking cycle being behind the curve is why the yen just keeps weakening. And so big money, we just talked about it, big money has been playing the short yen side for some time. And there is going to be a trade. I don't know when, Chris, and you just pointed out something that I think about way more often than I should. This dollar yen 160 field, I didn't trade during this time in 2015, but the 2015 euro Swiss franc blowout move that took place was one of the most insane currency moves, and it felt eerily familiar to exactly what we're talking about. So this candle here, this is a monthly candle on the euro Swiss franc. We've talked about this like a dozen times over the years, Chris. This move, right, where they pegged, quote unquote, 1.2, and they said, we are not going to let the euro depreciate against the Swiss franc past 1.2. And they said that for a long time. And for a very long time, traders were like buying the euro Swiss franc every time it would get close to that level because it felt like it's going to rebound upwards. And then one day, the Swiss National Bank said, we're no longer doing that. And the thing dropped thousands of points in minutes. And so, or thousands of pips in minutes. And so the reason I'm bringing that up is because many people are making the assumption right now that the dollar yen will be defended at 160 and the Bank of Japan will not allow it to go higher. But that's not a certainty, right?
Yeah, that's dude. I mean, after trading through Swiss National Bank and actually being profitable from it on a couple different ways. One, I was short dollar Swiss, short pound Swiss during that peg break. And then on the way back, I rebuilt based on the inefficiency of that move. I rebuilt everything long against the Swiss to like the 38% retracement. It's like I made a lot of money in 2015 because of that debacle, but the entire industry changed. And 2016, you had the pound and Brexit, and they had several flash crashes. You had a 2018 flash crash, a 2020 flash crash. I do not feel comfortable at all. Even with stop losses in, I wouldn't feel comfortable putting a stop loss at 162. If that thing breaks and goes to 170, 180, I mean, what I'd rather do is let a flash crash happen, then position myself, but not be victim to it and trying to trade something with negative swap and holding on for dear life, hoping to intervene. It's like, it's just not a trade, man. It's just not a safe trade. That's all.
Yeah, it's a tricky one. And again, I would not be surprised whatsoever if that day someday came where one day the Bank of Japan, kind of gives up or on, trying to defend a certain level, and traders sense blood and they just rip through those highs. So really tricky on the yen. If you're trading currencies, I would say yen pairs have a lot of extra volatility in them for a reason, right? There's that huge uncertainty factor that makes them very volatile. Anyways, let's see, Chris, we've got about 10 minutes here before the Fed release, and then we've got the press conference. So some potential interest going to come into the market at that time. Do you think bigger moves for the index off of the commentary from the Fed or from the earnings stuff?
Earnings, honestly. I think it's going to be a typical Fed day. It's the last stand for Powell. I don't think he's going to say anything uncouth. I think he's just going to give a strip, maybe barely acknowledge the questions, and just keep it very vague and vanilla. If they're going to ask him if he's going to stay on, cryptic. He did a great job for so many years, just kind of talking both sides of the aisle and staying somewhat neutral. I think it's going to be just a nothing burger FOMC day. Earnings, everything matters on earnings. Honestly, I don't think the markets are going to hate earnings. I just wonder what the price action does by end of the month. So I think that we could have a push up into Thursday's close, because that would be a fantastic April. That could be one of the better Aprils we've ever seen, which is fine. But then come early May, that 7,000 level you talked about in S&P, I feel like we could get a pullback, and then we'll see if the market's going to find some support levels.
Do you think, or do you have any trades open, Chris, for the earnings tonight? Meta, any of those?
I do. I have the ones that are open. So let me go back to the earnings calendar here. So I have a trade on Google that was filled. Amazon is filled. Pending orders on Microsoft and Meta. They're all expiring on Friday. So Microsoft and Meta, I'm trying to pull. So this is the trade that I'm trying to put in. Okay, so Microsoft and Meta, since those aren't filled yet, what I'm doing is, so we're at 671 on Meta. The expected move on Meta, I think, is like 8.5% for the expected move. I've got to average about 11.5. All right, I was a little off there. It must be Microsoft is 8 point something. So 11.5. Let me take Meta, go down 11.5. So 11.5 is around this like 595 to 600 zone. So the trade that I put on for Meta is, let's see here, working. So 605, 600, and 590. It's a broke wing butterfly.
Okay.
So if price was going to drop, it has to drop to the expected move and stay there. So if we gap lower and we push lower, then I'm going to be in a little bit of trouble. It's defined risk of like $400.
Okay.
But if it goes, let's say it goes sideways, no risk. If it goes up, no risk. If it goes down a little bit, no risk. I'm just trying to get the trade filled for my defined risk trade, and I have a profit trap right around that like 600 level. So my break even is 595, which is exactly that expected move. And so if we, have a bad earnings, they get filled on the premium I want, but we try to fill that gap by Friday, again, there's no upside risk on the trade. So if we blast up higher, no risk. Same thing on Microsoft. I looked at the expected move. I'll show you here. This one I think is like 8 and change for the average earnings print.
Yep.
This is 8.73. So I did 8.73 from current price, puts me down. 8.73 is around 386. So my trade on Microsoft is the 390 by 385 by 375 broke wing butterfly, trying to get that thing filled for credit, no upside risk. And that way there's a way to survive the trade if it gaps lower. There's a way to get a profit trap if it gaps lower at the expected move. And then the other one, same thing. It's like, it was a pretty easy trade. I think that we could beat just because we already have enough momentum. Market's going to love just seeing positive earnings. Give it one more thrust into Thursday. I have my potential concerns that we went so far so fast into April that May is like a pause, a consolidation, let things catch up, kind of cool off some of the overbought conditions that we saw with that big win streak for 12 or 13 days. So yeah, that's why I'm playing some of these earnings. So I've got skin in the game until Friday, and we'll see what they look like. Apple too. So I'm trading all the big ones. So Google, Microsoft, Amazon, Meta, Apple, I have trades in all of those. I'm going to look out tomorrow since we're after market. I'm going to look out tomorrow and maybe try to find one on Eli Lilly. We just had a 50% retracement on Eli Lilly. MasterCard, you're long Visa. So did you pick Visa over MasterCard? Like, do you like, Amex, Visa, MasterCard? You just pick one for any particular reason?
I liked, I can show you on my screen just for fun, why I picked, basically I picked Visa. MasterCard was about the same in terms of my interest in it. And then I chose it over AXP in just a second. I'll show you. This was just my earnings calendar here that we've been working on here on the stock box. This takes a look at the average earnings move 1 day later. And that's, of course, we only have a couple data points in here since we started tracking this stuff. But just showing here that generally speaking, in the releases that we've had recently, Microsoft moved about 6.5% 1 day later. Meta, and that's of course in either direction, kind of forecasting that 11%, let's say on the high end. Amazon 7.6%, Google 1.6%. Eli Lilly, as you mentioned it there, I just pulled that one up, 7%, and Apple around 0.5%. So of course, these things can move much more than this. It's very dependent on how the market takes the latest earnings. But as time passes, this will get more accurate as it will have more instances to study the historical average move. But yeah, I mean, I think that short puts for me on any of these would be interesting. Although a lot of them have bounced significantly from those lows. We just talked about that. So they've become a little bit less attractive for me personally. And then on the stock scorecard side of things, if I take a look at AXP is getting a decent reading within Stockbox, but we've added these, Chris. You might find this cool. We added a price to earnings growth based target, a price to free cash flow based target, and an analyst median target. What it does for these two is it looks at the historical averages of price to free cash flow, for example, or price to earnings growth. Based on the earnings growth, it builds a target for each stock. So we've recently been adding some cool new target features. So when I looked at AXP, we have a bullish reading here, but still some expensive metrics here in regards to like price to sales, trailing 12-month PE. Visa might have gotten a little bit more expensive since, but you can see pretty much all of our metrics here, our valuation metrics, are looking really attractive relative to the stock's 3-year average. So the stock has definitely gotten cheaper than it usually trades in recent times. So that makes the stock even more attractive to me. We also have an analyst median target of $400, price to free cash flow target of 407, PEG based target of 339. So the average, which is what Stockbox does, it takes the average of these, gave us about a $370 price target on the stock. So I think that there's more upside for Visa, and I own shares now. I'm happy to sit in them and see where those go. But just to follow up on the Magnificent Seven stocks going tonight, when we talk about, for example, Meta, right? I already own shares of Meta, but if we took like Amazon, for example, I own shares of this one. But then if we look at Microsoft, I don't own shares, but the stock has already rebounded sharply here, up 20%. Still could be some earnings vol crush plays that you could take, and I'm sure you're, like you just showed us, you're doing. So maybe that opportunity to take advantage of if the stock doesn't move much post earnings, or moves lower, moves higher, and kind of fades afterwards, which is very common within earnings reports. There's some opportunity there. So we'll see, but I think that there is, today is a huge earnings day. I know we're all here for the Fed commentary too, but I would tend to agree with you that most likely earnings report stuff is going to be much more market impacting than the Fed today, because today is Jerome Powell's kind of like signing off day. He's unlikely to ruffle the feathers too much. You never know, things could take place. But for me, I'm kind of in the camp of looking for buyable dips. I'm watching the Russell. I think there may be a directional play for me on the Russell to try and, maybe take a stab long on maybe just IWM. So I'll keep an eye on that one. But I am still sitting kind of cash heavy, waiting for some dip opportunities if I get them. And as I mentioned, I am interested in buying some GDX if gold continues to roll over here. That would be, by the way, Chris, that'd be a little bit more longer term for me. If we can get like a move down to 81 on GDX, that's more of like a buy and stick it there for a year and see what happens.
When you brought that up, so I drew out a little symmetry on GDX. So look, my thoughts on gold, I talked about this earlier in my segment. I think that gold, to really kind of rattle the loose hands, I think gold could make another low, like so. And I think we come down to maybe, this is GLD, so maybe around the 360 zone or lower. I'm a buyer there for sure. So I looked at GDX. It doesn't quite price action wise play out the same way, just because we don't have that clean flush. But if we just go symmetry here, Nick, high, low, lower, high, lower, low, then again, I know you put a put in here at 83 and you'll work through it, you'll repair it. That's fine. But for me, as far as like if I did a ratio spread or something down here around like 70, like a 70 by 65 ratio spread, Love that trade. In fact, I'm looking at it right now before we jump into FOMC.
Yeah.
Let me look at it. GDX.
While you do that, I'll just go over a little bit more info on gold while you pull that up. Couple things on gold to think about. And, first of all, I just want to take a quick look at institutional money. They've maintained a very bullish exposure to gold over time. This is the COT data history. The yellow line represents institutional long positioning over time. You can see it's been pretty persistently bullish for some time. The macro story for gold is one that's kind of mixed in the short run, but still, in my opinion, longer term still looks attractive. What I'll explain on that side of things is if we take a look at our asset scorecard and look at gold here, just punching in gold from a fundamentals perspective right now, you have inflation that's kind of mixed, but you have a jobs market that has been upbeat recently. That kind of hurts the case for gold in the short term, in the here and now, because again, strong jobs kind of put some kick in the step of the dollar. The economic growth rate data has recently been better than expected as well. Retail sales were strong, consumer confidence. So I don't think we have like a collapsing economy to kind of say, oh, rush to gold. And that's a big part of what we're looking at here. So the 4-hour and daily chart trend are also in pretty obvious downward trends. But longer term, I still think that there is a kind of bull case for holding on to gold in my portfolio. National debt's rising dramatically, yields globally still on the rise. There's a kind of a long-term outlook that I have on gold that is still very positive in the meantime. By the way, if you don't have access to either of our tools, Edgefinder or Stockbox, our sale is ending tomorrow on this. If you don't have access to it, we'll drop a link here in the live stream chat to where you can speak directly to a member of our team to take advantage of our 40% off discounts before they end. We are also setting up payment plans if you need help with that. Again, just click this link, speak directly to a member of our support staff, and they can get you set up with access to that. Interest rate decision just got dropped, of course, unchanged. Don't even have to look at it. It is definitely not going to be a shock surprise. So the Fed funds rate stayed unchanged at 3.75%. We'll see if there's any sudden volatility anywhere in the meantime, Chris.
Nick, I've got a ratio spread on GDX. I'll throw it in Pulver Alerts. It's not a big one. It's $110, but it's pretty safe. But 86% chance profit. If I own shares, I'm going to own shares around $55. I'll own shares around $55. So nice. Willing to own it there for sure.
Yeah, I feel like, again, long-term bull case for gold is still intact for me. I think short-term, I'm actually with you. Like, I think there is more likely downside in the short run. So again, I'm kind of playing both sides here. I think short-term, you do have some downside pressure on gold that, I mean, look at the technical chart and it goes a long way here in my view. You have this impenetrable fortress uptrend in 2025 into 2026. And I've called it the invincibility trade. The invincibility trade seems to have kind of broke here, right? You had that unending upward trend. And when it broke, I mean, Chris, those were pretty memorable moments when we were watching that melt up. I was long gold. You had closed out of a lot of your very successful trades on SLV and GLD, but we're feeling the FOMO. And then, you know, granted, I felt FOMO a week later because what happened is I was long gold. I mean, I caught this move like almost perfectly.
Right.
And when this thing dropped, I got trailed out, right?
Mm-hmm.
And then the market started going back up and I felt like an idiot. I was like, did I just really give back a huge chunk of this monster trade? And both of us, I think, were kind of ultimately proven to be okay because, of course, what happened next, gold crashed and actually has gone lower since then to where we currently sit.
Yeah, dude, it was a wild. It just like I said, that my running joke was it was the granny trade. When literally my fiance's grandma asked me about buying silver, and I'm like, okay, dude, we got to have a top here. And literally, it was the next day because we were just visiting for the evening before. The next day was like the big 16% drop in a single day. I'm like, okay, there it is.
It happened to me at a friend's gathering. There were two guys there that were like, "We're getting into silver.
There you go.
What do you think on silver?" And I was like,
"Good luck.
You know, just be careful with it. Just, you know, I long term, I like it, but be careful."
Yep. Did you see that the Trump coin's down 97% since it opened? With that that little grift scam. Yeah.
So are we buying it or what?
I mean, it's got to get down to 99.99, and then maybe I'll take a stab at it.
Oh my goodness,
that's probably right around the corner
today.
All right, what do we have, dude? Powell comes to the stand at 2:30. rates are unchanged, 3.75. I don't think there's any big changes to the CME watch tool, by the way. I think this is still like a big pause until like mid of 2027. Let me check the probabilities here. So rate, dude, I mean, we're all the way out to October of 2027 before there's any uptick in that probability of changing rates.
Wow.
So I don't know how the market's like, oh, they're pricing this. Is like, there is nothing on the CME watch tool that shows they're changing anything other than a pause.
You know, Chris, let me think through this with you. This is what
Okay.
I'm thinking. On one hand, I look at this and I say, this is actually really bullish in one way for the stock market, because I am of the camp, I think you are too. We've talked about this a lot before. I'm a fan of like when the stock market doesn't really need rate cuts. Like it's cool when the economy, when earnings are growing, when people are staying employed without a bunch of stimulus being introduced. And of course, there's always to some degree stimulus going on.
Right.
But you know, I think where we could also draw the line with that is that typically a earnings driven growth in the stock market is less excitable in terms of price action than a multiple expansion growth. So what I mean by that is that when people thought the Fed was going to cut interest rates and that, you know, things were going to look good, the stock market tends to run up on enthusiasm, excitement around what people are willing to pay for stocks. Whereas now I think that you don't really have that, like, we're going to get a bunch of rate cut story, but you do still have a resilient earnings growth story, which I think is more of like this type of move. Like, I think when you have like rate cuts and stimulus, it's that kind of market. And when you have more of, you know, earnings are resilient, economy's holding in there, I think that's more of like a grind up market. Do you agree with that thinking?
I do. And also the way that we had that snapback in 2025 and the snapback here in, you know, March 31st, I think a lot of the thrust was given. I think the market has that kind of set trajectory. But I don't necessarily see, I think the grind is probably more likely than the blow off, but do not be surprised if the risk is to the upside. And this market just does the most ridiculous bull market that we've seen, where, you know, everyone thought, oh, this is just like the .com, but I don't think you've seen anything. I think, I mean, if we thought gold was bad, imagine doing that to the entire market. Right. Like all of a sudden it's scary. Like, I mean, how many years in a row have we had? So since 2022's bottom, 2023 was 20+%, 2024 was 20+%, 2025 was 18 with dividends 20+%. I just don't, I don't think this market stops necessarily without us having all the risk to the upside, where all the bears wave the white flags and throw in the towel, and their, you know, rational, logical bear market narrative is blown out of proportion, where they're just so wrong that they finally admit defeat. That's when I'm calling the top. It's the 2028, 2029, you know, something eerie is going to be like the 100-year anniversary of the Great Depression and the, you know, 1929 crash. It's like stuff like that is probably more likely than us, you know, dropping in 2026 with the midterms, and you got a kitchen sink approach, and you're running hot deficits, and I mean, things are changing. Like, Trump is the snow globe effect, and stuff is moving and shaking, but we still have a resilient earnings base. We still have good, strong companies, biggest companies in the world. It's hard to derail that train. And we're also accommodated from the fiscal policy side. We're not as accommodated from the Fed side, but that's what the market's going to test Warsh on. The market's going to test him as the new Fed chair. And I think that's what today is going to be about as well, is the market's going to sniff out, like, is Powell going to stick around? Is he not? I think Warsh steps in, and I think the market might throw something at him, but his reaction is probably not inject capital and stabilize, unless they're just going to blow up freaking private equity or do like another bank crisis like we had in 2023. I think he's just going to get tested briefly.
Yeah, and I think you said something there too with the whole data center build out, the AI stuff. While the Fed may not be, you know, injecting stimulus, that kind of is a proxy in stimulus into, you know, the stock market. You have all these ginormous companies issuing that they're going to spend a ton of money that they've hoarded for a decade. That is,
and they can write down depreciation in full, like from day one. So like the tax benefits of this year are huge, and it's like that is absolutely going into like the future spend that these companies want to be in this arms race.
I hate to say it because it's maybe overly simplified, but I really think that this market is semiconductors or bust. Like right now, it is, you know, you have the Fed pulling interest rates, you have oil near highs that it's been in years. Like, I'm not a bear, but I'm certainly not willing to say that you still get such a strong bull market without the semiconductor trade. I really think that if you want to get a idea of whether or not the market can continue, it's just keep your eye on what got us here. This whole thing, this whole rally has been fueled by AI excitement since the lows of 2022 into 2023. Chat GPT came online. Now it's Anthropic. Now it's, CapEx spending just going like crazy. Data center build outs are not slowing. And hey, I'm not doubting it fully by any means, because I think, I'm using it in my own small business all day long. I'm sure many people here are using it all the time to improve their efficiency. Like, there is massive productivity gains to be had here. Now, is that potentially getting overexcited? I would argue yes. Not necessarily.
I love a pullback.
Yeah,
SMH.
SMH pullbacks. And people will be in pain when that happens, because there's a lot of people who believe it cannot possibly. But semiconductors are like prime example of what goes up fast can come right back down real quick. Like, semiconductors are a very, very volatile asset, and they're also cyclical, and they're also a commodity that is very competitive. If Google starts to introduce more of its own chips, if they start to eat into their own demand for NVIDIA chips, or there's worries recently, that little bounce or a drop that we had yesterday, that was Chat GPT worries over losing ground to Anthropic and data center build outs being challenged. Like, it's a very exciting, and it's also a very sensitive part of the market.
Agree. I like, and also, so SMH is heavily weighted in NVIDIA. SOXX a little bit less so. So I've traded all of my like ratio spreads and puts on SOXX. I'm going to do another one here. I'm just going to look at it. So we have the recent low, end of March, 307, 306. I'm going to look at a 300 ratio spread. Let me see if I have something already ripping on SOXX. Let me find it here while we wait for Powell to come to the microphone. But SOXX is a 235, 225 ratio spread. So that's way, way out of the money. I collected 275 on that one. That'll just need some time. That's November. I'm going to look at something a little bit closer, maybe the 307. I got into these trades like well before the whole dispersion trade in February, March. But I think if the low is in at 307, premiums are pretty solid, dude. Yes, there's volatility, but if I went to, let's say, post midterms, November, building up to it, we maybe have some summer drama, some uncertainty. Let me just look. I like the time horizon just because the premiums will be richer. I think we finish near highs at the end of the year. Let me see what November looks like. So 300, if I did, I'm going to look at something pretty solid here, like 325 by 300. That's a big fat profit trap. Let me get a ratio spread here. I mean, this is not a bad trade, Nick. I get a $2,500 profit trap. If I took shares of this, I would own shares of SOXX. It'd be 300 with a $25 profit trap minus 440. I'd own shares at 270. Which from current price, 270 at these all-time highs, 270 is a discount of about 42%.
Yeah, 40%.
That's a huge fail. If we're not going to love the semiconductor AI race, then semiconductors, they're going to get pummeled. And it's like, I just don't think they're going to drop like that. I think they're too important right now to have that happen.
I mean, to be honest, one of the easier, well, let me not use that word. One of the simpler trades for me personally is buying the pullback in semis. The problem is there's been no pullbacks. And so in the meantime, I think that the whole market is going to be dictated by semiconductors, because everything is attached to it at the hip, right? We have growth of the economy attached to it. We have, because of course, industrials are the ones building the data centers, and you have all sorts of different software companies tied into it because they're spending all their money on the tokens to build out their software infrastructure. You have all the finance attached to this because there's private credit attached to it. There's banks attached to it. They're loaning to all these different facilities. I mean, it is truly a semiconductor-driven market for now. Things change, and a couple weeks ago it was all an oil-driven market. If oil's going up, then everything's toast, and if oil's going down, everything's great. So things change naturally, but I am generally of the thinking that this is an overdone trade, in my opinion, in the short run, but it is not a dead trade. I think semiconductors on a pullback still are a more attractive risk reward trade. I'm not making a prediction that I think the bull market's going to last 10 more years. I'm not able to say that. I'm saying I think the risk reward is best if you get pullbacks in semis and in the Nasdaq, et cetera. Maybe that's a little slower paced way to play it, is watch the Nas, look for pullbacks, and a risk defined bet that the market continues its upward trend is attractive to me. In the meantime, we don't necessarily have pullbacks on the Nasdaq, but who's to say we couldn't get one started in the next couple hours with massive earnings and, of course, the Fed stuff. But of course, if you do get pullbacks, here's the other thing that's a little tricky. If you do get pullbacks, it won't feel nice. It will look like the trade's over. It will look like the Fed's an enemy of ours now. It will look like earnings and profit margins are breaking down for the big companies. Like, that's what it would look like. But you kind of have to keep a level head and say, this market, risk reward wise, in the last 10 years tends to reward stepping in and buying that fear when it takes place. So until it breaks, that's kind of the trade I lean towards.
I just got filled for 445 credit on a ratio spread for SOXX. They have to drop 40+% from the all-time highs. I'm going to take it. I'm going to collect it. Should be a solid, $3,000-$4,000 by November. So I like it. Probability of profit, probably in the 80s. 93% chance of profit. Chance of assignment is around 10%. I'd own the shares at like a 7 delta. So, I mean, it'd be a really, really low trade with an and by the way, SOXX, the Ivy rank, Nick, is 86.3. At 100, that's like, dude, you got to do something with premium anything over like 50 or 60 is like Tasty 101 sell premium. So we're at an 86 Ivy rank, which means any type of calming of that instrument in general. It's just crazy that it's 86.3, 86.4 to the upside risk. I'm curious what the skew is on like the puts versus the calls, but nevertheless, I'm still doing a put ratio spread.
Yeah.
So our trades in.
Crazy moves on that front for sure. Of course, keeping an eye on yields. Someone in the chat pointing out there was, thanks Sluggy, says 3 votes for a hike. So a little bit more hawkish tone perhaps from Fed stuff. We'll keep an eye on that in the commentary coming up. And, we'll see what the transition to Kevin Marsh looks like. Taking a look at 10-year yields here today, they are pushing back up towards those highs. And so this is another thing I would argue is a bit on the concerning side for if we take a look at the last couple months, right? You've had the war stuff sending yields higher, and then they cooled off a little bit, but now we are back on the rise, right? We're back on the rise with yields. And yet the stock market sitting at highs. That's where I kind of feel that you're stacking things against the bulls here. You have rising yields, rising oil, and what I believe personally to be a bit of a overextension in the semis world that we just got done discussing. So all that to say, I like the bull side, but I think that in the short run you have a little bit more concerning stuff to worry about. I think the yields being up is maybe one of the larger concerns.
4.6 is the level. 4.6 is where it gets painful. 5 is where something breaks. That's my opinion.
Yeah, 4.6 is this level here.
Yep.
Yeah, interesting.
So 4.6, I think it gets everyone's attention. It creeps over 4.6. We got problems. 5 is a problem. 5 is like probably the bond. That's the bond market really snapping back in some way, shape, or form, clapping back. There's going to be some. I don't know. There's going to be like the bond market's going to flinch. It's going to have some type of reactive fix to it. That's the one thing you can't overthink or overlook is like, we probably have a backup plan for all this crap. So like if we see yields at 4.6, 4.7, 4.8, and things are looking really terrible, at some point you're just going to have like your ugly flinch of the bond market. It's going to be nasty. It's going to take a bunch of casualties, but it will probably be Fed's going to take action. Government's a part of it. You've got the levers and backstop stuff like at the helm. The issue that we talked about before is, let's just say that something breaks, Nick, and the Fed goes ballistic and dumps, $5 trillion of liquidity in the market, and the market doesn't flinch. It doesn't even bounce off those lows. Like then we've got problems.
That would be scary. That's
why you're long gold in Bitcoin, honestly. Like probably gold more so than anything else, but that's why you're long gold, because of some crap like that could happen.
Yeah, the 2008 world was that's kind of like emblematic of 2008 is we have only known in the last 10, 15 years, every time the Fed steps in, it's an immediate kind of saving grace moment. But market history education, 2008, the Fed stepped in to offer stimulus, and it was like throwing a Band-Aid on a massive open wound, right? It did nothing.
Right.
And they kept doing it, and eventually the market did bottom out, but it was 30, 40, 50% later. So can be that would actually be one of the more concerning things, Chris, would be is like if you had a sharp move lower, Fed tries to take action and the market completely rejects it and is lower substantially the next day.
Yep.
Ooh, that is a market signal that I would be cautious of.
Same. I think that's, again, it just shows that what we have done is we have rendered ourselves ineffective for all the measures we have to stop the bleeding and backstop the market. All of a sudden that becomes just much less effective, and that's a huge concern.
No, definitely interesting. Chris, what about I have a thought or question for you. You
Okay.
liked silver a couple years ago. Do you like gold more now, or do you like silver also? Silver kind of taken a hit here today, down to 71.17 spot price. Gold also taking a tumble here, continuing to push lower on a little bit more hawkishness from the Fed.
I still like silver.
Okay.
Do I like it as much as gold? Well, I'm going to treat it the same way. I mean, if I show the pattern here, high, low, lower high, lower low, lower high, lower low. Let's see, we kind of trough out this larger falling wedge. Again, I look at silver and gold as just give it time to be boring. I think that's what everyone that's wanting to speculate and go all over the direction. It's going back to all-time highs. Dude, I think it's just going to be a long accumulation phase. And look, if it's faster than that, great, because I'm not in a hurry to see gold go back to all-time highs. I'm not in a hurry to see silver go back to all-time highs. Look, we traded a 3 to 4 year bull market.
Yep.
I don't expect all-time highs in 3 months. It's like, let this thing work out. Let the loose hands get rattled out. So again, I've already got exposure when this thing was peaking out. I was just going out time and doing like 50s and 40s and 45s and SLV. I will, add more exposure when it looks better. I think we just make a fresh low and maybe get more boring in here. But once this is done and consolidating, I'm just going to stack up longs to the upside, and I'll just sell premium down here, and it'll become a boring trade again. So nobody cares about silver, but it's like the best part is the price target of my profit would be if I'm building a position around 60 or 50 spot price and we go back to 120 ever, that's 100% upside in silver.
Well,
I'll take that trade.
That's one of the reasons why, you're successful with this stuff in the longer term, is that you have that level of patience, because most people who got caught up in the craze around precious metals last year and start of this year there's probably a lot of people who are in like a ton of pain about it. They're like, oh my gosh, it needs to go back all-time highs. Whereas, yourself and myself too, and probably other people who are listening who like the precious metals, know that the true blessing that the gold and silver market could give you would be a couple years of relaxed consolidation, and we play the carousel again. I mean, I watched gold and silver do nothing for a couple years there, and it has a repeating cycle where everyone loves gold and silver when it's going crazy to the upside, and then everyone forgets about it and calls it a boring, useless, untradeable, uninvestable thing when it's down.
Right.
And I think if you're really somebody who likes having a little precious metals in your portfolio, the history of gold and silver are that when they go up straight line, unrelenting, and you don't know exactly when that's going to take place. But if you're kind of putting it in your portfolio as a hedge, you don't mind if your hedge is currently cheap, right? If you can accumulate it at a cheap level, like prices being down is a good thing. If you are somebody who likes precious metals for the longer term, let them stay cheap for a little while. And then someday, if history repeats, gold and silver have another moonshot to the upside. And also, just to follow up with our conversation, gold versus silver, as we've got to transition here to Fed stuff in just a moment. The gold silver ratio is sitting at 63.6. We have watched this for a long time. And basically the idea here is that when it is very low, the price of gold relative to an ounce of silver is cheaper. And when the ratio is very high, the price of gold in silver is very expensive. And so I show you this because, for listeners, which is the better buy? Well, if you're just going off of mean reversion and long-term historical, kind of values here, right now, maybe gold is still a decent pickup related to silver. Whereas you get these moments where silver gets incredibly cheap. And Chris, I remember you were pounding the drum in regards to like your own preference towards silver during this period of time, as the silver, cost of silver was very cheap relative to an ounce of gold, and then that thing swung like a pendulum the other direction.
It did, and I was surprised how quickly it got to like. I mean, how many years low was that switch for that ratio? I feel like we wiped out, probably 5+ years of the gold silver ratio as far as
you're talking about back to 2013.
Yeah, I mean, I knew it was like 5+ years, but I talked about the ratio around 50 or lower. It's like probably starting to favor gold more than silver. Yeah, I mean, we're doing back to that outperformance in silver is back to 2011. So
yeah.
Anyway, it was ridiculously fast. Now this is going to spend a lot of time doing probably nothing. And if, like I said, if it doesn't, and all of a sudden we're right back to all-time highs, great. All the exposure, all the bite-sized nibbles and income trades that I'm putting in right now, they'll all pay. But as far as my allocation and like really getting serious about a portfolio position, it's just not right now. I'm just not that interested in saying like this thing has to go back. And it's like, dude, the narrative played out, the market priced it in, it's forward thinking, it's looking at other stuff. And I mean, this market seems, and this is what this is the new market. It's like everything is so much more short term that it's like you just go and chase. It's amazing how there's a whole crowd out there. You can say it all started with GameStop and Wall Street bets or whatever, but there's a whole crowd that just so desperately wants anything to run, anything to chase, anything to find it. They try to, you buy it in, you pump it up. Option flows will drive prices higher. You get out before you're left as a bag holder. And, it's like we're seeing it on, it's not just individual stocks and meme stocks, dude. We're talking, this happened on gold and on silver and on oil. And honestly, I feel like this can also happen on the semiconductors. I think this can happen in the indexes. And that's where I would say we are talking more of a top is coming in a big way. But that's the type of crazy stuff that I think will happen before we ever have like a sustained bear market. It's just blowing off the freaking tops, man.
Yeah. And again, that's the thing with all of these sort of crazy moments is you just have to know how to play them. You can't get caught up too hardcore in a narrative because it can switch from underneath you. Yep. Dollar, just another one to check off here as we count down the minutes to, as Tiger in the chat points out, a moment of silence for Powell's last speech ever. Yes, indeed. And we'll see, at least from the way the yields market is working here today, yields are higher. Hawkishness still seems to kind of be the sneaky, increasing hawkish narrative still seems to be intact and in play here. And we'll see with Kevin Walsh, the switch out. I kind of have the opinion. I know that there is a lot of people who think that he is going to be, kind of I've heard people throw out the phrase a Trump puppet, but I personally think that, to an extent, he has to play nice with his peers, even if he wants to cut interest rates dramatically. If he goes against his own crew, things will not work well for him. It will be, and this also, I heard someone else explaining, Kevin Walsh has the potential to be the longest standing Fed official of history if he plays his cards right. Now, what do I mean by that? Well, if you play your hands wrong, where you're just, trying to strong arm what the president wants you to do, you'll get kicked out of there. People will be working against you aggressively. Whereas if you play the role honorably, as it is intended, it doesn't mean you can't make constructive changes and try and make improvements. But you do need the approval of your peers. It is a democracy role. So a democratic role. So, I think that kind of leans me a little bit more into thinking that, while things may shift, we may see rate cuts, but we may also see balance sheet reduction, which is a hawkish thing, a tightening thing. Right. So I'm kind of in the camp of thinking that he may be surprisingly more hawkish than what people are assuming about him. But again, bond market kind of seems to be shifting in that direction already as we speak.
Yeah, I mean, it'll be interesting to see if the market tests them, right? I mean, look at the daily chart for bonds; they're down. I mean, we really haven't had a nasty bond move since Liberation Day. It's been pretty contained. I said this, I don't know if it was last week, but 2025 after Liberation Day, everything in ZB and everything in TLT, 95% efficiency the entire year after Liberation Day.
Just sideways, cool,
just
relaxed.
everything was inside the expected move. So like everything that was priced out in options was perfectly efficient, always stayed with inside the expected move, roughly a 1 standard deviation or less. And so this flinch made the bond market tighten up in a big way. And I'm not saying it was great premium. I'm just saying, like, from the textbook, like, you know, strangle or the textbook iron condor, you had an entire year of everything was just perfectly efficient. And that's really, really good. So, you know, my concern is that that was a great year after that headache. So I feel like we have another potential, you know, symptom that's brewing in the market. That's where, like I said, I don't want to be on the wrong side of that move. This is why I've also reduced a lot of the bond exposure compared to having, you know, gold as an alternative and silver. Those have been much better plays. So yeah, I mean, I just think at some point the bond market has its day, and they can all be proven right with how, you know, they've been vigilantes for a reason and whatever, dude. I mean, we'll watch the yields and see if it becomes a problem. I also think the bigger top in the market and the potential bear market trajectory would also be if we start to see that the inverted yield curve, we haven't talked about in a while, Nick, but the US 10-year versus the 2-year, if this is up to, we're only at 52 basis points right now. If this gets up to like 200 plus points, so if this is like 2% yield difference, 2.5 to 3% yield difference, that's what's coincided with every major recession in the markets. We've had widening spreads like this where the 10 and 2 is 200 points different. I'd be concerned, but I don't know. Again, we keep saying this, dude. It's exhausting to be here and say, like, look, I get it. I'm cautiously bullish, but every morning when I talk to thousands of traders and it's like this, all negative. It's like, sure, but we're at all-time highs.
Yeah.
So what's your point? You know, it's like you're just going to you're going to exhaust yourself by just at some point. That's why bears just throw in the towel, because they just can't get it right. And then when they do, I told you so. But it's like a 5-year wait to get that to happen.
Sure.
You know?
Yeah, and that's the thing, right? Is it is a exhausting thing to try and fight. Also, I'm going to just pull up here the meeting here. We can get stuff started.
Okay.
No Powell just yet, but we've got the stand pulled up here.
He's going to ghost the whole crowd for his last press conference.
Yeah, he's like going to drop the mic and move out of there. Yeah, give me a second. Chris, if you want to go for another second, I'll get this set up on my side.
That's fine. That's fine. All right, so I'll just spot check price action here. Let's just do a quick jump into the short-term stuff. So markets are down a little bit, softer today, 0.39. I talked about those gamma levels earlier. The nothing burger price is around 71.35. The gamma level that'd be calling price today based on the expected moves around 7,100. That is showing me in the near term that it's probably the stickier level today that might be landing price. I hope that it does, because I have a pin price sitting right there that's worth, you know, maybe $1,500 or so. So we'll see. That'd be a lovely win on the day. That seems to be where price could be attracted to. But, you know, if we're softer going into his press conference, then Powell could certainly get price to jump right back off. Whether he says something or not, it could just be bouncing around. Maybe we still have that like 71.35, 71.40 level today. But 7,100 right now is kind of my front runner as far as where price can go and maybe settle into the close. But there's a lot that can happen in 90 minutes when it comes to an FOMC day. So that's spot price for S&P. I mean, everything's kind of down, right? Nasdaq is surprisingly up. Check this out, Nick. Nasdaq, I don't know if they gapped higher today, but we're actually positive on Nasdaq today. Q's and NDX up 0.08, 0.08. Dow is down 0.8, worse than the S&P, almost by double. Russell is down over 1% today. VIX hanging out, had a little rally. We are sub 18 today. Then rallied up to almost 19, so we're 18.83 VIX. The 1 month correlation is still up. When this gets to like 8, I tend to look for a little dip or correction. Dollars up on the day. Oil is way up on the day. Gold, as we mentioned, down. Silver down. I'm still looking for that to maybe make some fresh lows before I start buying more. Bitcoin, don't fight it. I mean, I think it's noisy. We probably have a rally to 90 to 100,000. I think that's a top. I think Bitcoin still. I'd love to say it's going to settle around like 40K or 30K as a bigger picture trader. It's not going to be fun or pleasant to see Bitcoin going down and see all the narratives around it until it gets so hated by everybody. That's probably the best trade, is buy it when everyone is like, you know what, it's going to zero, Bitcoin's screwed, and Michael Saylor's going to go broke and look like an idiot, and all of a sudden it goes back to 130K.
Well, we'll have to see. Chris, we got it pulled up here. I'm just going to mute my mic here. And
investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over, with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully. My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined. I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board, When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well. As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
Sure. So, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors. It is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was that?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
I don't see that at all. As I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase, and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags. So you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? We have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So it's a much closer thing on the committee than it was in March, and that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias, we've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. Well, first of all, we're going to have new leadership in all likelihood by then, and new leadership is going to have a very important role to play in that. So I won't be standing here at this podium to answer your question. So I don't know. As I mentioned, that's all I can really say is that we had a great discussion about that today. It's gotten to be a better question in the interim period. We had the discussion. The majority are still on the page of not feeling the need to move to that level, and I that's where I am. I get it, though. At a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow on, the new leadership also seemed rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools? So I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you can always be looking at new things. And if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil.
Hi, Chair Powell, Neil Owen with Axios. Can you tell us if you've been in touch with incoming Chairman Warsh? To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. The last process was with Janet Yellen, with whom I had worked for 6 years, and so it was. we were sitting down the hall from each other. So it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up, is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market? And should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that the biggest wage gains were going to people at the bottom end of the income spectrum. And we had many, many reports of it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were, setting up in people who were confined and like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock that happened essentially very, very similarly all over the world. That had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So I don't think that insight was in any way responsible for the high inflation that we experienced. So, I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates. And we for example, now we don't feel that the labor market is at all a source of inflation. So we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
Just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for, or what else?
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that, and I will leave when I think it's appropriate to do so.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. I'd like to ask you if you could explain a little more or characterize a little more the discussion about the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
So nobody, the three dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, it's a form of forward guidance, and you want to make them in a way that will be sustained and continue to make sense, and not something you need to take back, fairly quickly. So I think a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got 3 dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by, 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking and be able to pull them together and get consensus and move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be very good at that, I would think. So I think I'm not so worried about that process. I think that'll work itself out.
Howard.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention and not be a shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know it, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go in, if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be, they won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable, because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know till we know. So fortunately, we're in a good place to wait and let things develop.
Thank you.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with SEPs. Can you talk about why you see that as a net positive?
So we always said when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, we during the pandemic, we were moving like a lot at every meeting and sometimes between meetings. And doing that without a press conference, I think would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to. And I do think it's quite helpful to, I try to deliver a message on behalf of the committee rather than 18 other people going out and delivering their message. And it's going to be all over the place because we do thankfully have widely disparate views.
Okay, thanks. The other thing I wanted to ask about was the communications review from last year. Could you describe the debate last year, what changes were considered, what you wanted, and what prevented action, any action on those changes?
So yeah, I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it didn't have, we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something. Like I said, I think every new chair is going to look at our suite of communications, and think about what would be changes. We are the only major central bank that doesn't publish a forecast, and that's because we have a 19-person committee, and you try to do that at the board. That's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the New York Times. If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and that's really where it is. And as I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You just have to find that out empirically. Given our the fact that we're a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. Those hikes may continue to happen. And other things are going to start to reflect airline fares I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
You know, the neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it, you know, between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. You know, I think the labor market is still probably cooling off just a little bit. And I don't think there's much of a case for any case really for policy looking, you know, meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
You know, the thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? You know, the central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough, difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. And I think it's partly a function of the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view, does that take a rate cut off of the table? And secondly, by staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year. And it will depend on how long the strait remains closed and how quickly it can be reopened and that kind of thing. But remember, when gas prices go up, that's disposable income coming out of people's pockets. So they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down to offset the inflationary effects. So it's not the answer isn't obvious ex ante whether you should move your rate over because of that. We'll have to see how it evolves.
And the message it sends to President Trump by staying on?
I'll stand on what I said earlier.
Victoria. Hi, Victoria Guida with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law, but it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries. about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it too is, do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over these things. We're having to resort to, the courts to enforce our legal, it's not so much independence. It's really the ability to make monetary policy without political considerations. That's what we're talking about. And we've had to do that, and we've been successful so far, but that's not over. None of that is concluded yet. And it's really important. It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it, and I'd like to think that we can get out of that era and go back to respecting, what the law says and what custom has been, which is to, let the Fed do our thing. It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect for perfection, but do expect us to make, decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. What, do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to, to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient. And Chris Waller is particularly passionate about that. Of course, so are the reserves, so are the presidents. And, it's a question of how do you accomplish it? We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that, but everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine.
Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
You know, I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
You know, we're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and you know, the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that, but we try to get there over time in a way that does the least damage possible, and you know, our commitment to that is never ending and unshakable.
How would you describe the economy outside of the misbehaving inflation? I mean, it's still awfully resilient given all of the blows.
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive thing. If I can have that amendment, yeah, you know, growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that that continues. So you've got an economy that's growing at 2% or better. PDFP, which is private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's you know, in a sense, the labor market is in balance, but it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. You know, inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly. And we'll just have to see how that works out. In the meantime, you know, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. At the risk of beating the dead horse here, clearly 3 members objected to keeping that easing bias in the statement. And you said that the majority still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that, you know, the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think, you know, there's a lot of signaling going on when you change guidance like that. And so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now. But maybe it'll come to that. And the reason is because, you know, we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it. And of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
Matt Egan.
Thanks, Chair Powell. Matt Egan, CNN. You've made many tough decisions in your time at the Fed. And as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, we, all of us together, have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation of supply shocks really for 6 years. And that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management. And, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging. And we've tried to do our very best through these really challenging times. And I'm really proud of the work that I've done, that my colleagues and I have done during these years.
Now, to follow up on some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical? I mean, what are the consequences if either the Supreme Court rules against Lisa Cook or the Fed in the future decides to make decisions more around the political calendar instead of the economic data?
So every major advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations, completely ignore them. This isn't bipartisan, this is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone. And let me say, whatever people say, the markets believe in that we will produce 2% inflation. If you look at longer run expectations, markets believe that there's no sense in which our credibility in the markets has weakened. It's just not the case. It's people do get it, that this is our commitment and that we will achieve it, and it's priced in If you disagree with that, then you can go ahead and bet against the markets. But the markets are pricing in Fed credibility.
Okay, we'll go to Richard for the last one.
Thank you, Chair Powell. Richard Escobedo with CBS News. We talked a lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still spending, and how long can that go on in a world where if gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, certainly none from this, but you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts. You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy. So we're not like a European country where 50% of the GDP is in the external sector. We're also, as I mentioned, we're an oil exporter. So we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
He's going to be missed, dude. I thought he was a good share.
There we go. He's last one. That was a good sign off, I think.
Yeah, it was good. I mean, you can't not respect the guy. Like he's taken the high road on everything, despite all the finger pointing and tweets and whatever. It's like, just do the job. And I don't know. He's been a good share.
Yeah,
but,
I agree. Challenge a couple years too. COVID.
What's that? Oh my God, dude. I mean, all of it. Like ever since I've been trading, it's like you go back to Paulson during the Great Financial Crisis and Bernanke. You go to Yellen to Powell. It's like, I don't know how anybody can say their job is super easy. And people criticize 12 members of the Fed board in the chair more than any other entity. But it's like they have been there to backstop. And, I don't think it's easy to be, we saw it in the chat. And I know that Warsh maybe had mentioned like the forward guidance goes away. It's like, that's not good. I mean, the market, if the market is like trading blind, I just feel like you're going to have more emotional swings up and down. It's like the Fed at least provides, whether it's boring or not, they provide at least some stability. And at least they dangle the carrot out there where it's like, these are what we have in place to make sure that things are, what are their mandates? Price stability, full employment, liquidity. Like that's an important thing.
Yeah. And following the meeting, overall yields kind of stayed unchanged. Stocks moved around a little bit, but not too far in either direction. Chris, I guess final countdown, next 30, 45 minutes until we have earnings. And we'll, of course, be covering that stuff. Are you on tomorrow? What's tomorrow?
I'm on tomorrow morning, and then I've got a little segment with you guys on Friday morning as well. So I'll be on to see what earnings do and see you the next couple of days.
Awesome. Well, we'll shut it down there. We'll talk more about it, I'm sure, tomorrow. And I guess that's all we've got for today, guys. Thank you very much for everybody for tuning in. Thanks, Chris, for coming on, and we will see you on the next one.
See ya.
See ya.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.